and the Trump administration will clearly continue to create some pressure. From a bottom-up perspective, when you look at those companies, you have to attack very conservative assumptions with regards to development in markets such as the US and even potentially Europe. And only if given very conservative assumptions, you still think there's a lot of upside potential given earnings profile on a 3 to 5 year basis, then you would get into those stocks. So again, it's a stock by stock decision and framing within a long-term time horizon, but with awareness of short-term risk.
You mentioned what would happen if we saw another Trump administration, but do you actually think trade policies or any policies, really export controls, penalties, would change whether or not it's Trump or Biden?
I think they will probably come up in different format. If you look at the current negotiation that just took place, we had, to a certain extent, a lot of biting. But in the end, a common understanding that the relationship for the US and China is important to the world. It is important to China and to the US. So I think you have to discern the noise of that, political talk with what is going on in the background. And we know that in the past 18 months, there's been a lot of touch points between the two administrations, if you want. I think that this will prevail independent on who is in power in the White House, but the noise will probably be louder. So you want to be very conservative with your valuation assessment and understand that geopolitics will continue to have a growing role on markets.
Virginie, thank you. Virginie Masseneuve of Allianz Global Investors, thank you very much. Statement from the President on addressing national security risks to the US auto industry. Let's get to that statement right now. I'll quote some of it for you. China imposes restrictions on American autos and other foreign autos operating in China. Why should connected vehicles from China be allowed to operate in our country without safeguards? Lisa, today I'm announcing unprecedented actions to ensure that cars on US roads from countries of concern like China do not undermine our national security. I've directed my Secretary of Commerce to conduct an investigation into connected vehicles with technology from countries of concern and to take action to respond to the risks. As President, I vowed to do right by auto workers and middle-class families that depend on the auto industry for jobs. With this and other actions, we're going to make sure the future of the auto industry will be made here in America with American workers. Now, you can decide whether you want to put these two events together. We've just received this statement. We also understand in the last 20 minutes or so, we will not be hearing from the US Trade Representative Catherine Tai this hour. And we would have liked, of course, for her to respond to this statement from the President this morning.
How much heavy lifting is national security doing, and how much is it a fear of really blowing under the water some of the U.S. auto manufacturers? Look, a lot of people have been expecting this. How are you going to create a moat around the U.S. auto manufacturers at a time where the Chinese manufacturers are doing it cheaper and faster? Here's the question. What are some of these provisions? Is this tariffs? Is this just an outright ban? How far does this really expose to the potential for challenges? That's some of the questions.
Made in China EVs, as you know, are already subject to a 25% tariff. Got to throw in the 2.5% tariff on imported autos as well. You just wonder where this is going, how much higher it will be, and if this is about getting in front of what we could see from former President Donald Trump on this campaign trail.
Well, and then how much is there a daylight? I mean, you've been talking about that's a lot, Anne-Marie, but to me, between the two candidates, to me, there's just a real question, and you've brought this up, John. What does this mean in terms of U.S. auto manufacturers and whether basically certain of them are allowed by the U.S. government, whether they are prohibited from buying certain goods from overseas countries, because that could potentially harm national security? It raises a lot of questions here. I'd be really curious to hear some more details.
We'll pick up on that story in just a moment. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Another government shutdown may be averted. Congress's leaders struck a last-minute deal to provide one more week of funding after Saturday's deadline. It will keep parts of the government funded through the end of September, but other agencies like Defense and Homeland Security departments could still face a March 23rd shutdown deadline. Speaker Mike Johnson plans to bring the measure to the House floor today. Shares of Snowflake are plunging pre-market. If this loss holds 23%, it would be the biggest decline on record. The software maker delivered disappointing sales forecasts. It also announced that the CEO, Frank Slootman, is stepping down, and he will be replaced by the company's senior vice president of AI, who, it should be said, once worked for Google Advertising. AMC Theaters is cutting the pay of its CEO by 25% after a bad 2023. Fourth quarter profit fell short of estimates despite a sales boost from Taylor Swift and Beyonce's concert films. AMC stock has fallen significantly over the last year, but now it expects revenue to drop as much as 9% this year because of a limited film release slate. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the program, trade tensions between the world's largest economies.
America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country.
That conversation up next, live from New York. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Live from New York City, equities here down by 0.25% on the S&P 500. Yields higher by 4 basis points. The 10-year 430.73. Under surveillance this morning, trade tensions between the world's two largest economies.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China.
Here's the latest today. The Biden administration is weighing the fate of Trump-era tariffs amid ongoing tensions between the U.S. and China. The decision coming as competition ramps up for raw materials, electric vehicles, and chips to power artificial intelligence. Bloomberg's Vonnie Quinn is at the WTO conference in Abu Dhabi, and she joins us now for more. Vonnie, can you just frame for us that tension that's playing out where you are right now?
Well, let's just put it in the words of Paraguay, which put out a statement, John, saying literally that rich countries that have long wanted poorer ones to reduce subsidies and lower trade barriers are now being called on their own governments to reduce trade barriers. And they don't specifically cite things like in Europe, the carbon border adjustment mechanism, or in America, the subsidies for semiconductor manufacturing and for electric vehicle battery manufacturing. But that's exactly what Paraguay and those that support this statement are saying. They're essentially calling out the hypocrites, as they would see it, for subsidizing their own domestic industries and telling the less developed countries to not subsidize theirs. And in a case like India, for example, which is being seen as a real holdout here, India is trying to protect its 9 million fishermen and anglers that are trying to subsist on very low wages. And other countries are also trying to do the same for their populations, but also remember electorates. There are a lot of elections happening this year.
Vani, do you feel like people are getting split into camps where their countries are being forced to choose between China and the U.S. and to kind of sit with those people at the table and ignore the others?
To a certain extent, Lisa, there's a great word that is only used at the WTO. It's almost a new word, plurilateral. So it's the idea that you can have a multilateral agreement, but really only among the countries that agree with each other. And you don't hear this word used anywhere else except at the WTO. And in fact, I spoke with the Irish Trade Minister earlier on, who had a good insight into how conversations are going. He said there's a lot of pessimism around. And for example, on the e-commerce tariff moratorium extension, which is being held up by potentially India, Indonesia, and maybe South Africa, he said that what will end up happening if these countries don't agree to extending the moratorium is that you'll get a plurilateral agreement with all the other countries that do, and that these 3 or 4 countries will be left out. He said that would be a shame, and it would be a very difficult decision to make, and he hopes it doesn't happen. But that's essentially what he was hinting would happen. And there you have it, a split right down the middle with some holdouts, and they're not getting the concessions that perhaps they would like, and the other countries just banding together and deciding they're not giving those concessions.
Speaking of electric vehicles and subsidies, we just heard from the president. He's talking about the national security risk to the U.S. auto industry. We've obviously seen subsidies from China when it comes to EVs. You talked about this race for the subsidy race. Brazil talked a lot about this, saying it's the elephant in the room. Well, those kind of countries, what are they going to do to remedy that? Is there going to be, trade remedies to try to combat some of these subsidies?
I think the answer there is that they are going to continue subsidizing their people, at least as long as they get re-elected again, or as long as they need something else. And don't forget, they're also, in conjunction with the WTO meetings that are happening, they're also conducting negotiations on free trade agreements. So India, for example, right now is in active discussions with the UK, with Australia, with the European Union on free trade agreements. Now, none of them have actually come to a conclusion. There have been several rounds of negotiations with each individual bloc or each individual country. There seems to be stumbling blocks. I spoke also with the India Commerce Minister earlier, who arrived late because he was actually campaigning with Narendra Modi in India for likely elections in April. He maintained that all of these things are separate, that they shouldn't be combined, but of course we know that they're combined. You can't negotiate a free trade agreement without coming to terms with some of the problems that WTO members are trying to come to terms with right now. And the Director General earlier on today was very optimistic and said she hoped that there would be an agreement and that there would be what they call a chair's text at the closing ceremony this evening at 8 o'clock. Since then, and just in the last hour, we've been told that that closing ceremony has now been postponed till at least midnight tonight.
They've got a long list of things to work through. Vonnie, appreciate the hard work over there. Thanks for joining us. Vonnie Quinn there of Bloomberg in Abu Dhabi. Chinese EVs pose national security risks. That's where we are, Bramo. This is where it's going. We've been talking about this for a while. This is where it's going.
The fact that they're saying it's a national security risk because they're in your cars, they can see you, and what are they going to do with the data? And then they say, we're going to protect American jobs. So which is it, right? Is this truly a national security concern, as we've seen with the chips, or is this something more in terms of protectionism?
Well, it sounds a lot like protectionism. And what you hear, though, from Congress, and we heard yesterday from Senator Hawley, he was talking about what's going on in Mexico. China is going in on Mexico big time when it comes to EVs. And his concern is this is a backdoor for American consumers to get access to some of these Chinese electric vehicles. So one, going around some of these national security concerns, but also these cars are being made in Mexico, and they are price point-wise much cheaper than the EVs the United States is offering.
We'll continue this conversation in the next hour of Bloomberg Surveillance. Wei Li of BlackRock, Matt McGuinness of the Committee for a Responsible Budget. I laugh because, good luck finding one. Winnie Caesar of Credit Sites and Dime Brand CEO John Payton, all of that in the second hour of Bloomberg Surveillance. Up next, live from New York City on PCE Inflation Day. Equity futures negative by 0.2% from New York. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Inflation is not really in a last mile mode on its way to 2%.
The inflation data is going to get much more bumpy.
If anything, I think you're going to see this back and forth.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
The Fed is beginning to open the door for a change in policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P pulling back by 0.2%. We can talk about PCE. We'll do that in a moment. The inflation data about 90 minutes away. We could talk about Washington, D.C., avoiding a government shutdown. For now, that's good news. But we should probably talk about this. Protectionism and electric vehicles. The very fact that the President of the United States believes that Chinese EVs could pose a national security risk.
If that's the case, you consistently push that through. What then is the logic behind TikTok? What then is the logic behind a whole host of other things? We've already seen this with certain chips. Now we're seeing it with this new statement out with respect to electric vehicles. The next paragraph, though, of course, is talking about protecting U.S. jobs.
We've been waiting for this for quite a while. Let's be clear, we're still waiting for the policy. So this is where the policy is currently. It's 25% tariffs on Chinese EVs, Throw in another 2.5% on top of that for the tariff, the tax duty on top of an imported vehicle into the United States of America. How much higher is that number going to go?
Well, exactly. And who's going to buy a car when there's a 25% plus tariff on them? So potentially we could see the number go higher if they want to extract more tariffs when it comes to Chinese goods. What we know now just from the president is that they are announcing actions to ensure that cars from countries like China don't underscore national security interests. So they're directing the Commerce Department to conduct an investigation. What do we get at the end of the investigation is the big question. But to Lisa's point about national security, we've seen this administration really ramp up their concern about national security in China. Remember the cranes at the ports? That's now a big issue of this administration. If they're not going to allow Chinese cranes at ports or don't want to welcome them, why would they allow Americans to get in the car? But then the big issue, of course, is American jobs.
What is this industry going to look like in 5 to 10 years? We talked to Pierre Farragut of New Street Research about this earlier this week, whether this whole industry would descend into just a series of state-sponsored national champions protected by massive tariffs to prevent competition from coming in. And I'd ask this question this morning as well. Is the EV market struggling because of Chinese competition? Or is the EV market in this country struggling for other reasons?
It's a great point, especially because a lot of people will say that actually if the cars were cheaper, you'd have greater EV adoption. So a lot of people who are for this transition say you allow everybody in, you get to where you're going to go much quicker, but you don't protect necessarily U.S. nationals, which is, I guess, one of the main issues.
But China has the biggest hold because they have the ingredients it needs to make an EV. They have the access to the raw materials and 85% of the processing to make that battery. When I talk to people in the commodities world, they say China's long game isn't just selling the battery to the United States. It's saying you cannot have this battery unless you buy the car that's attached to it.
What's the retaliation look like, would be the question I'm going to ask as well. What would that mean for Tesla? I was just thinking about what emojis Elon Musk might use this morning on the prospect of having Chinese EV manufacturers basically prevented from operating here in America. Maybe a salute, maybe a cigarette again, after what he said about Apple, perhaps. But if China starts to say, you know what, tit for tat, we don't want you guys operating in our country either, then some of these Western manufacturers have got a big problem too.
There's also this issue of how they develop their own in-house technology. They've already kind of won when it comes to electric vehicle battery manufacturing. When we talk about chip and some of the chip sales from the U.S., from the Netherlands into China, basically, some of these executives are saying, we're not going to sell the chips, but they'll create their own. And that's going to create parallel systems that, you know, you're going to foster through this.
That's the latest from the President of the United States. More on that a little bit later. Let's just turn to the price action briefly and get you set up for that PCE data a little bit later on today. Equity futures right now on the S&P 500, negative on the S&P. We're down by 0.2%. Yields are higher by 4 basis points, 430.14 on a US 10-year. Coming up this hour, Whaley of BlackRock on why she sees inflation resurging. John Payton of Dime Brands on how his company is dealing with the weakening US consumer. And Winnie Caesar of Credit Suisse as corporate bond sales hit a February record. We begin with our top story, 90 minutes away from the Fed's preferred inflation gauge, the so-called core PCE deflator. Whaley of BlackRock writing this. Falling goods prices have been pushing inflation down, but we see that drag fading in due course. We think inflation will resurge due to stubbornly high services inflation, but we expect that to only become visible later this year. Whaley, I'm pleased to say, joins us now to build on some of that. Wait, let's just talk about it. Just give us some more detail on this, why we have to wait until later this year for this to play out.
While goods deflation is dragging inflation down as we speak, it's running at over -2% rate. So just based on that alone, we actually think that inflation could hit target of 2% later this year. But after goods deflation runs its course, we cannot extrapolate that indefinitely because that's in part due to pandemic mismatch unwinding. Then some of the structural forces like persistent wage pressure could push inflation higher. And geopolitical fragmentation that you talked about earlier on also could push inflation higher. But we believe that ultimately means that inflation will go through a bit of a roller coaster pattern going down before it then rebounds next year. Now, having said that, the last a few prints of PPI, CPI have surprised on the upside. So even as we go down, I think it's going to be a volatile ride. And today's PCE, clearly all eyes on that print.
Wait, how do you stay bullish on U.S. equities despite the fact that you expect inflation to be sticky and bond markets to keep reflecting that?
Well, markets can only focus on one narrative at a single moment. And for now, we believe markets are focusing on the narrative of immaculate disinflation and earnings being very, very strong. So what has happened so far this year is that on the one hand, rates market are moving closer to where we think things should be, which is around 3 cuts. At the beginning of the year, we're looking at 6 cuts priced in by markets, and now that's moving closer to 3 cuts. But on the other hand, earnings are really strong. You look at the first quarter, the latest earnings season reporting for Q4, it's actually almost twice as strong as the expectation at the beginning of the reporting season. So if you think about kind of risk assets valuation being ultimately just discounting future cash flow, discount rates is going up, but cash flow, i.e. earnings, are going up as well, which is why on aggregate markets are up. And we think that this kind of combination can go on for a while before markets then move on to inflation roller coaster, and that actually should become clear later this year rather than right now.
When the shiny object shifts direction, then maybe everyone will look over there. A lot of what you're talking about, the better earnings, the sort of more constructive feel, a lot of people say has been priced in. I get so many emails with the headline FOMO, oh no, FOMO, MOMO, and I'm just looking at this and thinking, okay, how do you know it's hit a top? Scott Rubner of Goldman Sachs said yesterday it's impossible to call the top to this euphoric stock market. It's looking tired. However, there is no catalyst for a potential sell-off. Is there a key moment for you that is that shift where you start to adjust?
Well, in terms of the positive sentiment hitting a wall and turning more negative, what we just talked about in terms of inflation roller coaster becoming clear is such a catalyst, and we're paying close attention to wage pressure and participation rate, for example, to monitor that. But in terms of markets priced in for perfection, actually, I would observe that whilst earnings are baked in to be positive, quite positive for this year, when it comes to rates, we're now kind of middle of the range, right? Like markets are pricing in 3 cuts for this year, which is just one more cut versus the kind of the October pessimistic kind of pricing. So because we actually think that inflation could surprise on the downside in the coming months and quarters, because goods deflation is very, very powerful, we can see rate pricing swinging wildly again. So as markets then kind of wake up to, well, maybe 3 cuts, maybe even more, and maybe even less, I think that actually could then create further volatility / momentum on the upside, even though ultimately we think 3 is where we're going to settle. But inflation falling to target is currently underappreciated by markets. If you look at 2-year break even, it's at almost 2.8%, which is the last time it was at these levels was in March 2023, when inflation was comfortably above 5% back then. So I think markets are really fixated on the last mile of inflation being difficult to achieve, when we actually think because of the powerful goods deflation, we could get there. But then the focus is going to get to the inflation roller coaster.
This sounds like a mess for later this year, Wei. I want to talk about the rest of the world. Never mind the United States and the prospect of that inflation roller coaster. So far, month to date, so this month, the Nikkei 225 is up by 8%. The CSI 300 in China is up by something like 9%. Wei, these are big monthly gains abroad. I think we had all-time highs in the last week as well in France and Germany. What do you make of what's happening abroad? How sustainable do you think this is, Wei?
Well, our biggest conviction currently in international markets is Japanese equity markets. We upgraded it twice last year. We continue to stay quite overweight in this market. The first wave of Japanese equity performance was very much driven by markets getting excited about the exit from decades-long of deflationary mindset. But from here on, we think that it's going to be catalyzed and driven by micro development. Earnings are coming through really, really strong. And we also think that, yes, this year is going to be the year where Bank of Japan start hiking rates, but they're going to be really careful as they do that because they don't want to accidentally make the policy mistake of killing this exit from deflationary mindset, which is why we think that market pricing for them lifting rates is a little too aggressive. We think that they will lift rates, but they're not going to move too far from zero, which is still a very supportive kind of monetary policy environment. You talked about China. Valuation is very, very cheap. There are catalysts in terms of policy support coming through, but fundamentals are very, very challenged still. We're talking about real estate overhang. We're talking about aging population, which is why when we balance all of these factors together, yes, we see that there could be some bounce from this very low bottom of valuations, but we're still neutral. We're not overweight to chase this rally, and we think that there are better opportunities elsewhere.
What's your pushback? Because we just heard from Virginie that she likes China. We heard from Evercore ISI's Julian Emmanuel that he also is bullish on China just because it can't go much lower. What would make you more bullish on a country that is the world's second biggest economy and has been all but left for dead by a lot of international stock traders?
Well, to be fair, we are neutral, so we're not underweight. We very much recognize that the valuation is compelling and there are near-term policy support that may well be behind some of the more bullish calls. But from a whole portfolio perspective, we're talking about risk-adjusted returns. And when we try to measure, even just looking backwards, kind of what the market were able to deliver the last 2 months or so on a risk-adjusted basis, is still less attractive than what we can get from Japan, for example. So we're neutral, is not too bearish, is not too bullish. From a whole portfolio perspective, we think that there are better opportunities elsewhere where we are, for example, overweight Japan, we're overweight US equity market with a focus on tech and AI, which we think that delivers continued runway.
This is going to sound so specific, but I just want to know what happens to the Nikkei if the dollar-yen drops from 150, Bramo, to 120.
I mean, it's a good question.
What happens, Wei, if we drop to 120 specifically? Now, I'm joking, but seriously, what happens if this Japanese yen picks up? Real strong rally off the back of the BOJ starting to hike.
Well, that's a very, very important point that allows me to clarify. We like Japanese equities on a currency unhedged basis, just to buffer in the fact that, well, 150 off the back of policy divergence, there is room for that to come back, right? And given the fact that Japanese equities tend to be negatively correlated with the currency, there is a auto correlation that we want to bake in this unhedged currency, Japanese equity call. Now, having said that, we do think, for example, like Bank of Japan, the next meeting is not really a live one because they're going to be so very, very careful not to make the mistake to kill this early exit, this early signs of exit from the inflationary mindset, which is why we think that, yes, markets think that it's going to really start hiking and create significant kind of policy divergence versus the rest of developed central banks because they are cutting and Bank of Japan is hiking. The divergence may not be as high, as big as markets seem to be expecting because Bank of Japan will be very careful because we're talking about, decades long deflationary mindset. They want to be so protective of this exit.
This has been a long, long journey. Wei, thank you. It's good to hear from you. Wei Li there of BlackRock. Dollar yen right now, break at 150, 149.96. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Republicans in the Senate have to decide just how loyal they want their next leader to be to Donald Trump. Mitch McConnell is stepping away from the leadership position after the November election. His successors are known, the most likely successors, that is, as the three Johns. John Thune of South Dakota, John Cornyn of Texas, and John Barrasso of Wyoming. Now, unlike McConnell, all three have endorsed the former president, though Thune held out until this week to do so. The SEC is investigating whether OpenAI investors were misled while the company was shaking up its leadership last fall. The Wall Street Journal reported that regulators are looking at internal comms by the CEO, Sam Altman, ones related to his ouster in November. Sources familiar with the probe say that the SEC subpoenaed OpenAI in December and told senior staff to preserve internal documents. OpenAI's board chair says the company will continue to strengthen governance. AMC Theaters is cutting the pay of its CEO by 25% after a bad 2023. Fourth quarter profit missed estimates despite the sales boost from both Taylor Swift and Beyonce concert films. AMC now sees a 9% revenue drop this year because the slate of films to be released is so limited. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, guess what Washington is doing? Kicking the can down the road.
The American people deserve better than this. You wouldn't run a peanut stand over how the Congress is trying to do the national budget.
I think a lot of people might agree with that sentiment. Live from New York City, this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
Inflation data 1 hour, 11 minutes away. Equity futures on the S&P 500 negative by, let's call it 0.25%. Yields inching just a little bit higher right across the curve, at 4 basis points on a 10-year. 430.73. Under surveillance this morning, kicking the can down the road.
The American people deserve better than this. You wouldn't run a peanut stand over how the Congress is trying to do the national budget. The fact that we do everything to avoid a shutdown. Well, the government's going to experience a national shutdown if we keep going with the debt that's accumulating in America. We'll look at the text. Again, it's one crisis to the next. It doesn't have to be this way.
Here's the latest. Congressional leaders reaching a deal to avoid an imminent government shutdown, agreeing to another stopgap spending bill. The House set to vote on the deal today, which would provide 1 week of reprieve, pushing the deadline to fund some government agencies to March 8th. A second deadline would be 2 weeks later, on March 22nd. Maya McGuinness of the Committee for a Responsible Federal Budget joins us now for more. Maya, I'll ask you a question that I think would be the opening of your TED Talk, so you could go a long, long time with this one, but just how unsustainable is this path that we're on right now in Washington?
Well, we have now kicked the can so many times on the fiscal situation that there is no way that we will be able to fix the huge debt threat that we are facing without really major shifts. And as we can see, when the government's talking about even very small changes, which is what's going on in this deal, they are basically unable to make very difficult choices and stick with them. So I don't like to exaggerate about this, but I think we're headed towards something very bad on the fiscal front. It doesn't just come from our huge debt, like deficit, interest payments, unsustainable entitlements, all of those things. it also comes from the massive crisis in leadership that we are seeing at this point, where nobody is able to really talk about this issue honestly, make the changes we need to, and we have already waited so long, it is clearly going to be very difficult to fix.
Maya, Trump, looking forward to November election, you're talking about leadership. Trump has thrown around that he's going to pay off the debt. That would be virtually impossible in 4 years. But are you seeing anything, regardless of whether it's Trump or Biden, that would make any implications, improvements in our government deficit?
Yeah, let me just hone in on that Trump point for 1 second. It is so impossible to pay off the debt in 4 years. You would have to massively double revenues, cut all spending, and then some. Those numbers are just pulled out of nowhere and make no sense. And that's the kind of discussion that doesn't help. The other kind of discussion that doesn't help is everybody promising all the things they won't do. Republicans don't want to raise taxes. Democrats don't want to raise taxes on 98% of people. None of the leading candidates with President Trump or Biden are talking about the real need to fix Social Security and Medicare anymore. The Biden campaign and in the Biden's budgets, he has talked about a number of revenue increases. There's no question about it. We need higher revenues in order to close this gap. We need changes in everything, mandatory spending, discretionary spending, and revenues. So there's something he's talked about. The Trump campaign, the Trump administration and in the campaign, they did talk about adding tariffs. That would raise revenue, but it would harm the economy. So net, that might not make any difference. But to your main point, nobody's talking about this as a big issue. Nobody's putting forth the policies that would really make the changes. But when it comes down to this, I will say that the Biden budgets have included some revenue increases that I think there's support for. The risk is, would they turn around and spend them on bigger spending programs, which we've also seen an appetite for.
The heart of the U.S. budget is entitlements, though. Is anyone willing to go there?
Absolutely not. Here is the truth. We have two big programs, Social Security, Medicare. Both of them have trust funds that are going to become insolvent in a decade or so. Instead of talking about all the reasonable measures that we have to put in place, and frankly, we should have put in place years ago, we have the major candidates not promising to touch those programs. And when you have somebody who, reasonably like Nikki Haley or Chris Christie says, we should consider some of these issues, you have to think about raising the retirement age for younger people, not things that affect retirees, but people down the road, they immediately get attacked for it. So we have very little political leadership on what is 100% true, that if we don't make changes, say to Social Security, there will be very devastating automatic benefit cuts to everybody on the program. Those will harm current seniors. So this void of leadership is really leaving people who depend on these programs even more vulnerable.
Yeah.
And it says even more about how broken our political system is, that people aren't willing to level with the voters. And the big competition between the two parties is, I'll give away more than you can give away, which brings us back to this unsustainable debt path that we seem to be stuck on.
Maya, I can feel your frustration, and I hear you, and I'm so glad that you join us. And I'm wondering whether people still take your call, whether you call them up and you're like, let's talk, and they're just like, I don't want to hear that I need to take my vegetables again. Basically, do people even take your call anymore?
So behind closed doors, there is a lot of activity. Not only are they taking calls, my calls, they're giving calls, and that's both true from members of Congress and folks on Wall Street, because the markets are starting to worry. I'm hearing this much more from financial leaders than I have in the past years when this issue was basically lost in Siberia. But folks in the markets are worried. And yes, there are members of Congress who are focusing on this a lot. There's a big group in the House called the Bipartisan Fiscal Forum, led by Bill Huizenga and Scott Peters. And they have a group of colleagues who all meet monthly to talk about this. There's a lot of effort to try to put in place a fiscal commission that would look at all sorts of things. Of course, you have normal opponents from the special interest groups, the AARP, the No New Tax Pledge crowd. None of them want to make any changes, but there are a lot of members of Congress who are starting to say this is not just weakening our economy, this is weakening our country from a national security perspective. And so they are really starting to work on this. The question is when we can get enough people and the political leaders to really be willing to have an open and honest discussion about it.
I have a feeling we'll be talking about this together for a long, long time before they do anything. Maya, thank you for being with us. Maya McGuinness there of the Committee for a Responsible Federal Budget, of which there isn't one right now. I am so negative about them ever doing anything on this until there is a major problem in the Treasury market. Bramo, and we know why. The moment they talk about doing anything, that gets used as sort of opposition research against the person who's talking about it. It's ridiculous.
Yeah, Nikki Haley, even talking about
Great
raising
example.
the retirement age. Why do you hate people? Why do you hate
the
the
Trump
retirement?
campaign took our interview with her about raising the retirement age and made ads. It was all over Iowa and New Hampshire. It's the third rail.
Not going to get fixed. Up next, John Payton, CEO of Dime Brands from New York City. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Getting a secret omelette recipe right now. I'm not sure you meant to share that. Okay, we won't talk about that, but I might start doing it. From New York City this morning, good morning. Equity futures right now on the S&P 500, negative by 1/3%. We're down about 1/4% on the NASDAQ. The data are about 1 hour away. We'll talk about that data in a moment. Into the bond market, 2-year, 10-year, 30-year. Earlier on today, this week rather, closed above 470 on a 2-year for the first time this year, 468.71. Yields a little bit higher here, Lisa, going into that data. We're up 5 basis points.
The whisper data, if there is such a thing for this particular metric, is that it's going to come in a bit hotter. And this just really is on the heels of what we've already seen, which is hotter CPI and hotter PPI. Whether people consider this data to trade off, we shall see. I mean, people will then say, well, it's just one data point, and then we'll hear that next week and then a week after.
Will it push out the Federal Reserve a little bit more? Let's talk about bringing in the Bank of Japan to the rate hike conversation. Dollar yen, bit of yen strength out there. Break of 150 on dollar yen. briefly, back to 150 right now, negative 0.4%. I said earlier, we haven't seen a close below 150, I think in about 2 weeks, Lisa. BOJ board member talking up the possibility of rate hikes down the road.
Okay, this is what talking up the possibilities of potential rate cuts, it sounds like. The price target of the Bank of Japan is finally coming into sight. Oh my goodness, they're going to hike, right? So this is sort of, all right, people have been fed this line before, and so that's the reason why you're not seeing that much action.
Wei Li of BlackRock talked about how long this journey has been, decades.
Yeah.
They're going to move slowly.
Well,
They're going to move slowly. Under surveillance this morning, the data point we've been waiting for all week, the core PCE deflator, the Fed's preferred inflation gauge due out at 8:30 Eastern time. We'll also get jobless claims and personal income and spending data too, plus more Fed speak. We'll hear from Bostic, Goolsbee, Mester and Williams throughout the day. Already heard from President Williams in the last 24 hours. I have to say, based on the dot plot that they put out in December, let's park the news conference with Chairman Powell. Ignore that. Just go to the dot plot. They talked up 3 cuts, implied by the median dot. They're still basically at 3 cuts, and that's what he's speaking to.
Do you think that they feel really good? They're like, you guys are working yourselves into a frenzy in the market. We're staying in one place, and you're coming around to kind of realize that you should have not been freaking out this whole time.
Fortunately for them, they don't have to mark to market every day.
Yeah.
If you did have to mark to market their views every day, I mean, maybe they'd change a little bit, but they don't. And they've been right so far.
Yeah.
So far. Let's see how far this gets pushed out if that inflation data comes in hot again.
Especially considering the fact that there still has enough financial easing that could potentially foster further types of inflation. This is something that people are worried about.
Some latest news on the politics as well, just from Illinois, barring former President Donald Trump from appearing on the Republican primary ballot over his role in the U.S. Capitol insurrection 2 years ago. It's the 3rd state to ban Trump from ballots. Trump planning to appeal the ruling, calling it, quote, unconstitutional. We're going to have a few hearings, aren't we, over the next few weeks?
He's already appealing the one that came out of Colorado, so the Supreme Court is already going to look at this. They'll make the final decision. More importantly, the Supreme Court yesterday says they're going to take up the case involving Trump in terms of immunity regarding the January 6th case happening in Washington, D.C. Now, regardless of what the Supreme Court does, it was a win from the Trump campaign yesterday because this is just a delay tactic. What he does not want is to have this trial happen before the November election. Our polling shows that if he's convicted of a crime, he's going to lose votes.
Let's get to that polling. The new swing states polling coming from Bloomberg Morning Consult. The former president holding a 5-point lead over the incumbent, with perceptions of an improving national economy failing to translate into any insignificant increase in support for Biden. The poll also finding that 80% of swing state voters would describe Biden as, quote, too old. A majority would describe Trump as, quote, dangerous. That's quite a choice, isn't it, going into November?
Too old or too dangerous? I would note that the too old issue happened after the special counsel report that said that this was an elderly man, which is why they didn't want to charge him in the documents case. And then the too dangerous, we've seen an uptick in some of this. This happened after Trump's comments on NATO. And some people think that he's degrading NATO. And then part of that dangerous is also the fact that I just mentioned, if he's convicted of a crime, he's going to lose votes.
That's enough politics. Let's get to the data. Another read on the U.S. consumer coming at 8:30 Eastern time with personal income and spending data just around the corner. Dime Brands will be taking a closer look at the data. The owner of Applebee's and IHOP restaurants reporting 4th quarter profit that beat estimates, thanks in part to an aggressive promotion strategy. The CEO, John Payton, saying this: during the year, we found that guests limited their discretionary spend in response to economic pressures, and that this value-conscious behavior continued in the 4th quarter. While this certainly creates challenging and dynamic market conditions, it also allows us to leverage our expertise in delivering exceptional value. John Payton, I'm pleased to say, is with us around the table. John, good morning.
Good morning.
I want to kick it off with one thing, and I mentioned it in the commercial break, so we should continue this conversation. When Walker Hayes put together that song just a few years ago, did they talk to you about that ahead of time? How did that work out?
So Walker Hayes wrote the Date Night at Applebee's song 2 summers ago, and it was a gift from above. We did not know it was coming. He is an actual Applebee's fan. He wrote about date night with his wife at Applebee's, and he's been an amazing partner to work with. We jumped on it. Our marketing team was all over it. And so, that led to the commercial, TikToks. He did over 100 appearances for us. He was at our national conference. Fabulous.
Free marketing. How many people are doing date night at Applebee's now? How cost conscious are they?
Well, speaking of date night at Applebee's, we just had our date night event where we had a coupon available for $200 that enabled you to eat at Applebee's every week for 52 weeks with a $30 discount. So it was a $1,500 value for $200. We made that available at midnight a few weeks ago. It sold out in a minute. some less than a minute. Some commentaries said that we broke the internet. Not quite that. We added server capacity, we added customer support, and our sites might have slowed a little bit, but it was so popular, we did it again on Valentine's Day, 1,000 date night passes.
So what are you seeing with respect to where people are coming from? Is it the same crowd that's always gone to Applebee's that just have more discretionary spending? Or do you see people sort of that might have gone elsewhere, maybe that was more expensive, coming to Applebee's or going to IHOP for an omelet that's very fluffy?
A couple of insights, Lisa, about the consumer. We get asked that question a lot. Are people trading in or out of the category? And from quarter to quarter, we'll see a few more people come in at a higher income level, a few more people at a lower income level. But over time, it's actually fairly consistent. You know, our core guest from a demographic perspective earns about $50,000 to $75,000 a year. And that is literally looks like America, right? We've got 3,600 restaurants across the country, and so our guests are families with children, older couples who've retired who come to IHOP every day for breakfast. And so what we do see from a consumer behavior standpoint are a couple of things. The first is throughout 2023 and into 2024, you know, our guest at all three of our brands has been remarkably resilient to the extent that it really surprised us a bit. We do see from our data that they're eating out 1 or 2 times fewer, you know, per quarter than they did before. And when they make their choices, they are still looking for full service dining because, you know, prices are up almost 20% in restaurants versus 2019. And so if you're going out to eat and QSRs become more expensive as well, they want that experience, they want the service, they want everything that we have to offer at Applebee's and IHOP and Fuzzy's. Once they find us, they're very value focused. And so, you know, the percentage of our tickets that are taking advantage of our LTOs, our limited time offers, and our value portion of our menus are up a few ticks from where it was before.
So then how do you maintain margins at a time where we keep talking about the fact that people are demanding higher pay? There's a whole question about worker retention. There's a whole question about just the input prices of a lot of foods and how they have remained sticky. How do you manage that?
Yeah, so margins are the biggest challenge in the industry right now, particularly for our owners. We're at 100% franchised, right? So the impact of labor cost, the impact of cost of goods into the restaurants affects our franchisees directly. And so we focus on 2 things. We're doing everything we can to drive the top line, right, through really creative promotions and value offerings. And we work with them on re-engineering as best we can the bottom line. So last year, for example, working with our franchisees, we took out $50 million in cost across the system. And we focus on things that are sustainable and repeatable, so technology, process improvement. You know, one example is we're putting in automated beer dispensers, which saves, you know, hundreds of thousands of gallons of beer a year by having more accurate pours and less waste. And so that's the way we're trying to automate things like that and help them manage their costs.
Yesterday, Wendy's had received a ton of blowback when they came out and they're going to do dynamic pricing. They said, no, we're not going to raise prices on busy hours, but maybe we'll offer some discounts online. Could you ever see yourself doing that sort of mixed pricing depending on peak and off-peak hours?
Yeah, so I come from the hotel industry, right? And I led revenue management when I was at Starwood Hotels for a long time. And as you know, with airlines, with hotels, no 2 people pay the same price for the same hotel room or the same ticket, depending on what channel they purchased it on, when they purchased it, if their loyalty status. You know, we've looked at it for restaurants, but we don't think it applies to us or our customers at this time.
We're hearing the word price gouging a lot down in Washington, D.C. Can you talk to us about what you think about that? How difficult is it to bring prices back down to where they were a few years ago?
It's difficult to bring prices back down when labor costs are escalated and labor is pretty sticky, right? It tends not to come back down. The cost of goods, and primarily food into the restaurants, has stabilized, and we're even predicting some deflation in the cost of goods into the restaurants for Applebee's in 2024, about flat to maybe +1 for IHOP. When you translate that to pricing, and it's our franchisees who make the pricing decisions because they own the restaurants, typically, you know, pre-2019, everything is pre-2019, right, these days, our franchisees raise prices about 2 to 3% a year. The last couple of years, it's been more in the 5 to 8 or 9%. What we're seeing now with the stabilizing of both labor and cost of goods, we think they're back on a path to that 2 to 3% over the next couple of years.
I want to talk about the automatic beer dispenser, not because I'm actually interested in the automatic beer dispenser, but it sort of highlights the amount. And we talk about, just you get a little bit less, and that's one way to manage.
It's not a little bit less, it's an accurate pour.
Okay, understandably, but then you could just make it an accurate pour of a little bit less. I mean, how much is that something that's going on around the margins?
So never ever. So right now, our definition of value is great food at a really accessible price, an abundant portion, right, and the experience you have in the restaurant. And Applebee's and IHOP and now Fuzzy's, but Applebee's and IHOP in particular have been around for 50 and 65 years, and they've cemented their reputation in consumers' minds as the value-oriented brand in both their categories. And I'm a former chief marketing officer, and what I've been taught about brands is that people go to brands they know and they trust. Yep. And you can trust that Applebee's and IHOP are always going to have an abundant portion, and that's sacred for us.
A pint should be a pint. I'm talking English measures, of course, but a pint should be a pint, Bramo.
Well,
no shrinkflation.
I just want to say something.
But warm. The pint is always warm, which I haven't understood.
Well, it's a different kind of pint.
Yes.
We can get into that another time.
I have to say, in Europe, they actually have lines on all the wine glasses to have accurate pours, so it's something that they've been doing
should
for a
have
while.
an accurate pour.
Okay.
I've saved this to the end of the conversation because I don't want to upset you too much, but this is going to sound terribly rude. So forgive me for the framing of this question. I'm just blunt, British, call me whatever you want. How dependent are you on 40% of this country remaining obese? What happens if Ozempic actually does something about it? What happens to you? What happens to this organization?
So the response to that is that our menu has something for everyone, right? And if you went to IHOP years ago, it didn't have plant-based proteins. It didn't have a series of egg white omelets. It didn't have gluten-free pancakes. And the same is true. The same is true at Applebee's. So what's important for us is that no matter what the dietary orientation is of someone in that family, that we have something for everybody.
So right now, are you factoring in any kind of shift from that type of change, given the fact that there is a pretty rapid adoption for these weight loss medications?
Yeah, we haven't seen yet any material impact on our business, and we're not factoring it in terms of our predictions about traffic and comp sales, which really our focus is on the menu and ensuring that whether you're at any one of the three brands, there really isn't something for anyone depending on how they eat and how they choose to eat.
But because of this craze almost, do you feel like you're pushed more into being healthier on your menu?
That push preceded Ozempic, right? So the way Americans eat, has been journeying slowly, right, toward more healthy eating over time.
Have the portions changed?
Our portions have always been the same. It's more about what we're offering and having a broader menu.
Can I just ask one more question about the technology investments? I'm just wondering, do you think that we will always have service in the form of a human?
I do. I use the phrase that we are not a technology company that happens to serve food. We're a food company that embraces technology. And so, for example, at IHOP, we've just rolled out a new POS across the whole system. We've got 50 restaurants to go, and with it came handhelds for all of our servers. And so our servers love it because they're turning tables faster, they're making more tips. Our franchisees love it because we're turning tables faster, and we're also raising the average check because servers are attaching beverages more often. Sometimes you forget to put that soda on the tip when you're on the check when you're really busy. So it's technology like that we're using to enable the experience. We're also allowing guests via our app, if they want to order in advance and then seat themselves at the table, they can do that. But it's more about how they want to interact with us and giving them all those options.
John, this was great. I promise never ever to share the secret ingredient in the omelette, okay? Ever.
I have no idea what you're talking about.
John, thank you. John Payton, the Dime Brands. John, thank you very much. This was great. Appreciate it. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. Labor Department caused confusion across Wall Street. They sent an email about rental inflation in January CPI. That message was to so-called super users. It suggested a surge of single-family detached home inflation was caused by adjustments to subcomponents weightings. The pop in owner's equivalent rent was a large factor behind the strength of January CPI. The BLS says it is looking into the data. Shares of Paramount up in the pre-market. It predicted significant earnings growth this year. Investors then overlooked a 6% sales drop with traditional TV ad revenue falling. Subscriber growth also beat estimates on its streaming service, which Paramount says will be profitable domestically next year. Apple resellers in China are slashing the price of iPhone 15s. It's an unusually long slump in demand. China sales for them dropped 13% in Q4. It's the weakest performance in years, thanks to economic difficulty and Huawei competition. In January, Apple offered a rare price cut on their website. And that's your Bloomberg Brief. John.
That's not looking good. Danny, thank you. Up next on this program, corporate credit in focus.
We've got to watch credit spreads. They are so incredibly tight, not just investment grade, but high yield as well. That's kind of a canary in the coal mine for me.
That conversation up next, live from New York. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Live from New York, going into that economic data about 42 minutes away. Equity futures on the S&P negative by 1/3%. We are higher on Treasury yields by 4 basis points, 430.73. Under surveillance this morning, a record month for bond supply.
We've got to watch credit spreads. They are so incredibly tight, not just investment grade, but high yield as well. That's kind of a canary in the coal mine for me. Watching those credit spreads, when are we going to start to see some of those widen out?
Here's the latest. U.S. corporate bond sales setting a February record of $172 billion as falling yields drive investors towards debt and companies take advantage of lower borrowing costs. Willie Caesar of Credit Sites writing, quote, though we're still positive on the long-term outlook for corporate credit, we have been surprised by the relative resilience of credit spreads in both IG and high yield during this most recent move higher in rates. Willie Caesar joins us now for more. Willie, let's get into it. You've got a perfect way of framing it. Just how tight are things on a multi-year, dare I say, multi-decade basis?
Multi-decade for sure. So things are very tight, but there are some caveats to that. We still have pretty wide CCC and distress spreads in the high yield market, though the higher rated parts of the market are trading through the 2021 tights that we had at the height of pandemic-fueled liquidity. And then in the investment grade market, we're trending towards those kind of mid-2000s, 2005 tight, but you still have financials really lagging, and that is what needs to get some giddy up in order to hit those cyclical tights again.
So there is scope for these spreads to get even tighter, is what you're saying?
There is scope. We've been a little bit cautious on that. We feel like this start of the year is almost a repeat of last year, right? We had a slew of kind of Goldilocks data, some surprises to the upside in inflation, yields moving higher, credit spreads tightening on that, and then something happens. There's always something that happens. Now, our big catalyst was the Fed being a little bit more hawkish at the January meeting. That has manifested, and yet credit spreads are still super resilient. And I think that speaks to the technical backdrop where investors have been really underinvested, under-allocating to credit risk, and now they're kind of holding their nose and having to play catch up.
You know, I'm listening to you, and I've been hearing about tight credit spreads. The all-in yield has basically flatlined, around 7.9% for high-yield bonds. Basically, spreads are offsetting some of the fluctuations that we're seeing in benchmark rates. How much would it actually be a negative for spreads, spreads widening, bonds selling off, if you get rate cuts, if you get some sort of indication that the economy is weakening? How much is this actually directly correlated to the strength that we've seen in the economy that bleeds through to a better credit backdrop?
Yeah, that's a great point. And the Fed is really threading the needle, right? If you have really dramatic rate cuts because there's a problem, because the Fed is chasing inflation lower or outright deflation, and we go from 5.5% to 2.5% on Fed funds by the end of the year, I think you can safely assume that high yield spreads are going to widen at least some. I don't know the magnitude because there would be cash coming out of the front end, out of money market funds and into the fixed income markets, but you would assume that defaults would rise.
This raises this question of refinancing risk, and we keep kind of asking it in different ways, whether this economy essentially is fine with 5.5% benchmark rate, that these rates are not too high to really restrict growth and frankly, even inflation. We're seeing all this issuance. Is this a problem, a sort of default risk for companies that are borrowing at these new higher rates?
Well, it's interesting because it is a problem for some companies. We've had this distressed cohort in the high yield market. About 10% of the market on an issuer basis has traded at this distress level, indicating that the market is saying, enough is enough, your capital structures are not sustainable, we're not lending to you. And that number hasn't really moved that much over the past 12 months, even though spreads have tightened up pretty considerably. But then you also have private credit borrowers moving back into the broadly syndicated loan market because there's more demand and you're seeing tighter pricing in the BSL market, which is indicating to me that investors are actually pretty constructive on the lower rated parts of the market.
Is this the zombie washout then? You're going to see like the ones that are not going to work out. That's something that we've been talking about basically for the past 20 years, hopeful?
I don't know that we get a full-fledged zombie washout. I think that there's still too much liquidity.
You've disappointed Lisa now.
I know. I'm so
you
sorry.
should have been like,
been waiting 4 years for the zombie workout.
It takes a long time for the zombies to get killed, right? It's just the circling of the drain. And yeah, I mean, we have these waves of energy, of retail now, of telecom and media, healthcare to an extent. They're kind of the new zombies, but it's just taking an awful long time because there was so much cash injected into the system. People still need to put those dollars to work. And the new mantra now for LevFin is stay alive till 25 and see where policy rates are.
We've talked about that mantra. I think that's absolutely amazing. You know what's interesting to me is that the zombies are actually thriving now, some of them at least. The cruise lines. We talked about the cruise liners being zombies in the spring of 2020. Look at them now. Look at the equity of them. Last year, some of the top performers on the S&P 500.
Yeah, look at the icon of the seas, just drawing in thousands of people. But this is true. And it's the money. It's the reason that people have so much spending power.
So where do you see difficulties? Can we finish on that? You said the scope for tightening, further scope for tightening would come from the financials. Could they also deliver scope for widening as well, based on some of the struggles we've identified over the last few months?
Yeah, I think that there is that potential. We've been positive on financials. I think that the reality is it's going to take a while for spreads to recover, especially for regional banks. People don't have a good handle on what the new issuance requirements mean for valuations. People don't have a good handle on CRE exposure and what does that mean for asset impairments and write-downs. And so these things just take kind of a long time to actually work through.
Are we seeing much fragmentation, dispersion within financials based on CRE?
Not necessarily based on CRE, but based on big bank versus little bank.
Large versus small?
Yes.
Regional still struggling?
Absolutely. Not necessarily struggling, just not tightening to the level that they had tightened before. They used to trade inside of the GSIBs because of that supply dynamic. The GSIBs were always having to issue a ton of debt. People were like, oh, I own all the JP Morgan that I could possibly own. And so people would be buying, you know, the SunTrusts and the Truists and the
Just say that again. Regional banks used to trade inside large banks.
That is correct.
Massive change in the last 12 months.
Massive change.
Yeah.
Just huge.
Just all supply, because they used to be the ones that sold less debt than the big guys. Now the big guys can do no wrong, and that's been playing out in every market.
You'd always see it after earnings season. You'd see the monsters come out and do these massive bond issues.
Yeah, well, we still see that, but people are ready to suck it up because there's nothing else that's really been sold.
Arguably, they want to be there.
Exactly.
Versus the other place. Winnie, this was great. Appreciate it. Winnie Caesar at Credit Size. Amazing to see how tight credit spreads are in the face of record bond supply over the last few months.
Yeah, but this is exactly commensurate with this idea of a hawkish Fed. This is a Fed that sees a stronger than expected economy. And then you've got investment grade buyers, you've got high yield bond buyers that can lock in 7.9% returns over the next, say, 3 to 5 years, whatever the average maturity on this index is. Not so bad, not so shabby. So that's what people are looking at, and the reason why things look pretty intense.
Pretty impressive. Bramo's been waiting 4 years for this zombie workout, things to
It's been longer than
explode.
That. It's been a lot longer.
Well, I'd say, yeah, I mean, I'm being kind.
More
I'm
than a
saying like
decade.
post-pandemic. You've been writing about it for more than a decade.
I've been wrong every time.
It's going to happen. Coming up in the next hour, Emily Rowland of John Hancock, Neil Dutt of Renaissance Macro, and Bloomberg's Ira Jersey, and Craig Trudell as well. Fantastic lineup. PCE data, 34 minutes away. Looking around corners, Bramo, warning people about
everything that didn't
downside
happen.
risk. There's nothing wrong with that.
Exactly.
You've got to consider this.
Yes, well, I have actually already got a message. What should I consider now? The shutdown isn't happening.
Exactly.
What's next?
There is always something to consider and worry about.
No doubt about that.
From New York, this is Bloomberg.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
Inflation is not really in a last mile mode on its way to 2%.
The inflation data is going to get much more bumpy.
If anything, I think you're going to see this back and forth.
The data can switch quite rapidly, which in turn can have a rapid effect on financial conditions.
The Fed is beginning to open the door for a change in policy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Inflation data 30 minutes away, live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now. We've had upside surprises on CPI, PPI, PCE is just around the corner.
Yeah, and this is really going to be sort of a key driver. If we get 3 for 3 in terms of hotter than expected inflation prints, what does that do to market expectations, not only of Fed rate cuts, or are they going to happen, but also just in general, how sticky this inflation
Everyone
really
seems
is.
to be very relaxed around the Fed call now. Governor Waller, what's the rush? Jan Hatzius over at Goldman. Cuts aren't urgently needed. We've priced out the timing of that cut. We've reduced the magnitude of them for this year. What's left?
Well, at this point, do you start thinking about the Jim Bianco view of the world, which is, do rates have to be higher for a substantially longer period of time, or we're talking about one cut or no cuts? I don't hear anybody else talking about that. I just hear Momo, FOMO, or oh no. I mean, seriously, I can't get over this.
That is your favorite line,
really gold, yeah.
Isn't it? Fantastic.
It is.
What was it? What was it again?
This is the reason
FOMO,
why.
oh no, Momo.
FOMO. No. It's is Momo, FOMO, or oh no.
Okay.
And he's basically talking about the momentum rally.
Stuart Kaiser, thank you for that. Super helpful. Let's talk about the data. After this morning, after, let's say, 8:35, all we're going to be talking about is next Friday and the payrolls data. And we've joked, of course, like we joke every single time, that the next payrolls report is the most important one since the last one and before the next one. This is super important. January was a mega blowout, monster upside surprise job report. If you get a repeat of that, then never mind pushing out rate cuts. Maybe Jim Bianco of Bianco Research gets a few more phone calls, because we'll be talking about maybe the possibility that they need to do more.
Or that they need to not cut at all. And how much does that start to affect risk assets?
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Able to apply for some of these claims or apply for job insurance. So potentially could be a bifurcation, who is losing what jobs. Look at UPS. They showed up this huge deal for workers, these union workers, but they lost some people in the back end.
Sometimes I just want to applaud Bramo. Just, you know, sometimes I do. I just sit here.
I feel like that right now, though.
This rant was better than the last rant. And that rant came 30 minutes into the program, so you've still got an hour to go.
Thanks for rating them.
Let's get you set up for the next 60 minutes or so. Equity futures right now negative by a third of 1% on the S&P 500. Yields are a little bit higher, up by 4 basis points. 10-year, 430.92. Euro a little weaker, dollar a little stronger on that currency pair, negative by 0.14%. 108.23. Coming up through the hour, John Hancock's Emily Rowland on the road ahead for the Federal Reserve. Ira Jersey of Bloomberg Intelligence pushing ahead to key inflation figures and responding to them. Neil Dutta of Renmac breaking down the data and potential market implications. We begin with our top story. Wall Street bracing for the Fed's preferred inflation gauge just under 30 minutes away. John Hancock's Emily Rowland saying this: "It is like the Fed gave a last call at the party to end last year, and now it's trying to stop serving, but no one is leaving." It's frustrating that when that happens, right? This everything is awesome sentiment is likely priced into markets. Emily joins us now for more. Emily, why aren't people leaving?
I'm sure you guys don't remember ever staying too late at the party, right? You know, I'm bringing back, you know, I had to go back.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Because it ranks really high on our quality metrics, but we need to think about diversifying away from that, given the fact that tech's trading at about a 40% premium to its long-term average. So we're looking at areas like U.S. mid-cap equities, which are trading at a 1 standard deviation cheap to their long-term average, and they're actually trading at the cheapest level to large cap since 1999. So that's an area that we want to look at. We've talked before about the benefits of onshoring and how that's impacting that space, especially mid-cap industrials right now, an area that's benefiting from fiscal spending that, by the way, we're still doing. And one reason that the soft landing narrative continues to play out here is because we're pumping about $2 trillion into the economy at a time where it's growing 3%. This is pretty wild.
So let's talk about the anatomy of this party, right? We had Jay Powell come out and say, basically endorse the idea of cutting rates, even if we don't see pain in the economy. People have gone to the races with that. Yeah. What is to say that this party will be stopped, even if they cut rates fewer times than expected? What would it take? How high is the threshold at a time where the fundamentals people keep saying to us look pretty good?
Right. Well, there's a kind of dark side to this improvement that we've seen in economic growth and this modest reacceleration in inflation, which is that the longer rates stay elevated, of course, the more likely it is that we have some type of financial accident or that something breaks, or even just that it starts to put more stress on the economy. So the good news for the economy, of course, is translating into this potential bad news on the rates front. You know, maybe it takes a while to get there. We're still kind of living in this never-ending late cycle environment, but ultimately higher rates should tip us into contraction. We're just it's really hard to see any signs of that right now.
Given that, and this is something that we were talking about at the outset as we wait for this 20 minutes, 21 minutes out from the
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
After the fact. So I think there is a little bit of wonkiness, to use a Lisa word, to the data here. As we kind of think about it, we got to take it with a grain of salt.
You mentioned credit cards. What about delinquencies? We are seeing them rise.
Yeah, and we're seeing a lot of use of buy now, pay later. And so consumers are pretty confident about their job prospects, especially today. So they're using leverage in order to continue spending. You know, I don't think it's a dire situation for the consumer. As long as everybody still has a job and feels fairly confident about the labor market, they're going to continue to spend. But the leverage is there. And I think it's a concern as we head into the back half of this year.
How difficult is it to get a 22-year-old to buy bonds? How tough is that?
That generation is actually pretty conservative, believe it or not.
Are they really?
Totally. Yeah.
I thought it was all sort of meme stocks, Bitcoin, let's go, let's go, let's go.
That's my 14-year-old.
Yes,
so that's
my 14-year-old
that's the even younger
He's
age
totally
group.
into that.
Same.
He wants to buy an NFT and he wanted to lever it up.
So their risk appetite is sky high.
Yeah.
Where does that conservatism come from?
What happens when they're 19 and don't leave the party?
Well, they do this thing called loud.
What happens?
They do this thing called loud budgeting. They go on TikTok and explain to their friends what their budget is going to be, and their friends hold them accountable.
Right. That's actually happening.
Not in my household.
I hadn't heard of that either. Thanks for that. Emily, you're sticking with us, I hope. Emily's sticking with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The SEC is investigating whether OpenAI misled investors when it shook up leadership last fall. The Wall Street Journal was reporting that regulators are looking at internal comms by CEO Sam Altman relating to his ouster in November. Sources say the SEC subpoenaed OpenAI in December, asking senior staff to preserve internal documents. OpenAI's board chair says the company will continue to strengthen governance. Weight Watchers shares falling after Oprah Winfrey said she would leave the company's board. If that fall sticks of 25%, the stock would be trading at a record low. Weight Watchers is trying to stay relevant in the Ozempic era. Winfrey says that she'll still work with the company in, quote, elevating the conversation around obesity. She's served on the board since she struck a deal with Weight Watchers in 2025. Republicans in the Senate have to decide just how loyal they want their next leader to be to Donald Trump. Mitch McConnell is stepping away from the leadership position after November's election. His most likely successors are known as the three Johns: John Thune of South Dakota, John Cornyn of Texas, and John Barrasso of Wyoming. Unlike McConnell, all three have endorsed former President Trump, though Thune held out to do that until this week. And that's your Bloomberg Brief. John.
Danny, thank you. Let's just pull up WW again.
Yes.
Down 25%. It's unreal, isn't it?
Okay, this is the other part of the story. Yes, she's stepping down from the board, but it was reported in December that she is taking a weight loss drug as a maintenance tool and basically said, I'm absolutely done with the shaming. So it raises this sort of existential question of meal planning and these other types of tools if the poster child is also using the weight loss drugs.
What's a maintenance tool?
To maintain your weight lower. I don't know. I'm not sure.
I think it's either exercise or Ozempic, depending on how you maintain.
Sort of microdosing Ozempic, is that it?
You know, Oprah Winfrey, we welcome you to come on the show and to join us to talk about it and the trends that you see coming forward.
About losing weight?
And about the use of medication as a maintenance tool.
Okay, up next on this program, not that. Counting down to the data point of the week. I mean, we could do
You're
that.
disgusted with me. It's fantastic.
Really, what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. let's throw in the towel, rates are going to go lower, time to buy, yields.
You just walk 30 minutes a day on incline on a treadmill.
Yeah, there's that too.
It's a secret weapon.
Yeah. Is that, are you recommending? Well, I can't.
Incline, 30-minute walk.
Leg day, don't
yeah,
do it.
you know, don't do that.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
A lot of controversial points on this program in the last 20 minutes. Perhaps the most controversial, Coors Light quality beer. I mean, like, I'm just saying it. That's not, you know, I'm not saying it's not. Just
the question mark.
Respond.
Yeah,
discuss.
yeah. Discuss.
There you go.
Yeah.
Equities right now. Negative 1/3 of 1% on the S&P 500. Yields up by 4 or 5 basis points. 431.32. Under surveillance this morning, counting down to the data point of the week.
Really what's happened in the bond market is it looks like the market got ahead of itself. It said, okay, this is over. Let's throw in the towel. Rates are going to go lower. Time to buy, yields. And what's really happened is we're not there yet. And thus we've seen a very strong movement in yields upward again, which is very consistent with this idea that the market went too far and got too excited.
Here's the latest. The Fed's preferred inflation gauge, the PCE deflator, just moments away. The stage is set for the data to jump following January's hotter-than-expected CPI and PPI reports. Bloomberg's Ira Jersey joined us now. Ira, what are you expecting, you and the team, in 12 minutes' time?
Yeah, so we're expecting the 0.3 pretty much in line with consensus, but we will be looking at a lot of the details. You know, where is the inflation being generated from, and then of course some of the core measures, which the Federal Reserve will certainly be keen in on very closely. So you know we get a 0.4, and you know we're probably off to the races, looking at 4.5% on 10-year yields pretty quickly, John.
Ira, we've priced out rate cuts pretty quickly as well. We've priced out 3 or 4 of them so far this year. How much space is there to carry on doing that?
Yeah, I think it's possible, and more importantly, when even away from whether or not the Fed's going to cut rates at all, the options market is, so when you look at options on short-term interest rate contracts, are actually pricing for some chance of a hike this year, and that's a massive sea change. Remember, it wasn't long ago we were pricing for 6 interest rate cuts with 0 chance of any hike, and actually almost a 0 chance of only 1 hike, or 1 cut rather, and now the fact that we're starting to think that, hey, maybe the economy is going to be strong enough and inflation high enough that the Fed might have to not only pivot to no cuts, but actually be thinking about hiking is a really big sea change. Now, right now, it's mostly just like tail risk hedging, but at the same time, that has had significant, effects on the front end of the market. So you look at where 2-year yields are, 2-year yields to get back to 5% would not take very much. Pricing out 1 more cut would lead us back to about 5% on 2-year yields, according to our fair value models.
Ira, I want to just sit on what you just said. 4.5% is very seeable in your view, in a heartbeat, if we do get a hotter than expected core PCE print. Can you just talk about what that means with respect to positioning and whether you see the sell-off potential as greater in the long end at this point than even the short end, which already has done a lot of the work?
Yeah, so that's an interesting question, Lisa, because a lot of the positioning data that we see is much cleaner now than it was. So the market had been pretty bulled up not so long ago. That's shifted a lot. You look at some of the survey data of portfolio managers who manage duration risk, and now they're actually a little bit short. So while we think that this very tight range, look, in the last 3 weeks or so, we've only been in a 14 basis point range in the 10-year. We haven't seen that for the better part of about since 2021. So with that type of very tight range, it means that there's going to be a lot of people with stops and people who are long who are going to stop themselves out probably when we get above 435. And then that's what's going to, potentially move us back to 4.5. At that point, I suspect that you'll have some short covering. You'll have some people saying, well, 4.5 is an interesting place to get into the market. So that's an important stopping point. It's also on the technical chart. So Chris Kane, one of our chartered market technicians here at Bloomberg Intelligence, helped me with in a note that came out just this morning, looking at that 451 actually is a very interesting target, at least near term. Above that, you're talking about getting back to 5% probably on 10-year yields.
That's very, very specific. Ira, thanks for that. Ira Jersey, I know you've got to run. Appreciate your time. Ira Jersey there on the bond market. Talking up 2 levels here. One on the 10-year maturity that Lisa was talking up, 450. 431 is where we are right now. On a 2-year, the prospect of getting maybe back to 5%. The table's full going into this data. Emily Ronan back with us. Mike McKee around the table as well. Emily, let's talk about that. The prospect of going back to 450 on a 10-year, 5% on a 2-year. Do you think the equity market can keep looking past that?
I think that would create a challenge for stocks. There's been such a tight correlation until very recently, of course, with rates and equity markets, and I think you're going to start to see that challenge. I mean, talk about 5%. I don't think stocks would like that very much. I think there are certain parts of the market that would do fine. Again, higher quality, I think, is an area that can survive that. But you really want to think about leaning into fixed income, I think, in an environment and really grab a hold of those yields.
What's insulated equities so far? Before we talk about that change in what's been working?
I mean, it's just sentiment. It's incredible just to see, the parts of the market, like we talked about earlier, that have done so well, looking at things like Bitcoin and small cap growth stocks and unprofitable companies. There's really kind of an everything is awesome mentality permeating the market right now on hopes of this, not only soft landing, but no landing, which isn't really a thing. Or we would never have economic cycles. So I think we need to remember that economic cycle analysis does matter. It just doesn't exist today.
I want to go back to what you said, that you think that you could see quality hang in there. Yeah. This really raises a conundrum for big tech, because that has been the quality and the earnings. And yet a lot of people say that those valuations are so inflated because of rate cuts being kind of baked in. Yeah. How vulnerable do you think they are if they're both quality, but also a little elevated?
Yeah, I think the entire market would be vulnerable, but we have to look for those pockets that may be more insulated. Because of the valuations, there's absolutely a challenge there, and I think we're kind of past the point of reasonable, especially on a few of those mega cap names. And again, that's a reason that we think diversifying into areas that are actually cheap, which, by the way, the rest of the market's pretty cheap. and could be cushioned. It's kind of like, falling off a lower part of the staircase rather than from the top.
6 minutes away from that economic data. Mike McKee, let's talk about it. What are you looking for?
Well, we're looking for a slight increase, as we saw with CPI and PPI, but for slightly different reasons. And that may play into what happens. It's interesting what Ira said about the market going up, or at least bond yields going up, if we see a bad print, because that could help bring inflation down. One of the funny things about the PCE numbers are that they are influenced, or have been in recent months, heavily by trading on Wall Street. Portfolio management rose 5% in the last PCE number because there's been so much trading that Wall Street's making a lot of money. I call it the pogo problem. If you remember the old comic, we have met the enemy and he is us.
So we have about 5 minutes and 15 seconds. Emily, as someone who trades, are you trading on this number? How are you going to do it?
No, I mean, we don't think about things on a short-term basis like that. Over a longer-term basis, we're positioned. You all know we've been leaning into bonds here. Every backup in yields here we'll be looking at as an opportunity just to grab a hold of that income. And even if we see some chop in rates here today or over the next couple of months, I think the fact that we now have income in bonds and we can kind of add that back in, even if there's a potential challenge on the duration front, to us, that makes the asset class very attractive.
Emily, love this. It's good to see you in person, which I think is the first time in a long time, right? I can't believe that. We caught up with each other every month for 4 years. I can't remember the last time I've seen you. Maybe it was 4 years ago.
I think so.
Mental. Emily, it's good to see you.
Great to
catch up. Thank you. Emily Rowland, Michael McKee is going to be sticking with us as he breaks down that economic data in just a moment. Going into all of that, equity futures on the S&P 500 shaping up as follows. The S&P 500 negative by 1/3%. The data point, PCE, core deflator, month over month, the estimate 0.4%. Neil Dutt of Renmag breaking it down too. That's all next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Economic data 20 seconds away. Michael McKee's going to break that down. Renmark's Neil Dutta is going to respond. Going into it, the scores look like this on the S&P 500. Equity futures down 1/3% on the S&P. On the Nasdaq also down 1/3% in the bond market. Switch at the board. A 2-year, 10-year, 30-year, 2-year yields higher by 5 basis points, just short of 470, 468.91. With your economic data, it's Mike McKee.
Anybody want to know what's happening with PCE? Got to wait just a moment. It hasn't dropped yet. The computers are all being attacked by people on Wall Street. But I can tell you, initial jobless claims move a little bit. 215,000. It was 201 last week in the revised numbers. And here come the income and spending numbers. Income up 1%. Significantly higher than anticipated. It was a 0.4 gain anticipated by economists. Personal spending comes in as anticipated, up 0.2. Now the numbers everybody's been waiting for. The winners are PCE deflator up 0.3 as forecast. The PCE deflator year over year up 2.4%, which is basically just math. That's no surprise. The core comes in as forecast, double last month at 0.4, and the core deflator is up 2.8%, which is going to be a little bit of good news. That was what was forecast, but there was some fear that it would get pushed up to 2.9%, same as last month. And I can tell you the core for last month was revised down to 0.1 from 0.2. So it does look like at this point we're seeing a little bit less of the bad inflation news that we saw in the CPI, but we'll have to take it apart to get the full data.
I can tell you so far, Mike, the winners are the economists on Wall Street. Bank in line with estimates. Mike McKee, let's work through this price action. Equity futures totally unchanged on the S&P now. We inflected a little bit higher on the Nasdaq, now positive by 0.2%. The Russell up by 1/3. In the bond market, yields were up by 4 or 5 basis points at the front end, now up by just a single basis point on a 2-year at 465. On a 10-year, up by a single basis point to 427. In foreign exchange, euro stronger, dollar a little bit weaker. 108.45, Lisa, on the euro against the dollar.
You know, I'm looking at some of these numbers, and I have to say that they're all pretty much bang in line except for one, and that's personal income. And that comes in with the biggest gain since January 2023. Now, you either dismiss this as irrelevant or a fat finger, or you start to say, well, people are earning the money to keep spending, and that can keep this going for a longer period of time. So to me, that's interesting. Otherwise, all the numbers, yeah, you're right. It's pretty much.
Or you just turn to Mike McKee and say, Mike McKee, what on earth was that? What is that?
Well, we have to look, and I haven't got the breakdown of income yet, but we have seen fairly strong wages. And so that's what I'm trying to figure out here is where is this coming from? It is also January when we get usually get some additional transfer payments from the government into people's bank accounts. So that may be it. But give me just a second here, and we will find the answer.
You take a beat, Mike. I know Neil Dutta of Renmark is itching to get into the conversation. Neil, what'd you see?
Well, I haven't seen anything. There's no Bloomberg coverage.
You sounded like you were itching to get in, Neil. Give me something.
I wouldn't be surprised, Mike, if there was maybe some upward momentum behind dividend income in the over the month. I mean, didn't Meta announce a huge? I mean, wasn't that a big shock for everyone that they announced a big, dividend payment? And maybe that showed up in dividends, which drove the outsized gain in income.
But this is what we were just hearing from Emily, right, Roland? And this is what we were hearing from Mike, that basically traders are basically skewing some of these types of these numbers. Not, okay, you look skeptical, but basically changing the scenario because of the earnings that you get on Wall Street isn't typically what people think of when they think of income from going to a job and getting a wage gain. Does it matter from an economic perspective, Neil?
Well, and I mean, I think there's a lower propensity to spend out of stock market wealth than wages and salaries, but you know, I mean, the numbers are what they are, and you know, to me, what's important is that disposable incomes net of transfers, are moving up and to the right, and that very much mitigates the risk of recession.
We do have a winner. I have the numbers on personal income now, so give Neil his stuffed bear. He hit the nail on the head. Dividend income up 4.1% in January. It had fallen 0.2% in December, so a big swing there. Wages and salaries up 0.4. That's a little bit lower than the 0.5 in December, and also transfer payments up 2.6%. So I finished second in this.
I want a stuffed bull, Mike. You know me better than that.
No bears, stuffed bull.
Neil wins as well. Neil, consensus wins this morning, kind of, with the exception of personal income. You wrote a note earlier this week, consensus needs to wake up. Now, let's push aside this one. Why do you think consensus needs to wake up? What on specifically?
Well, I think, in my view, what's happening is, number one, I think the consensus continues to revise up growth. Now, people are doing that. If you look at Blue Chip, the Bloomberg News consensus, I think GDP expectations have been moving up over the last number of months, which makes sense because the data has generally been better. But I do think that there's still a lot of currency in the long and variable lag idea. So when you look at you know, people kind of mark to market the first quarter. Okay, that's going to be strong, but there's still a big slowdown expected in the next quarter. So there's this idea that any day now it's just going to kick in, and there's going to be this weakness. And I just think there's only so long you can keep doing that, and that's why I think the consensus has been sort of perpetually surprised to the upside. We are seeing a upturn in cyclical manufacturing, for example. So I do think it's unlikely that growth is going to slow down meaningfully between now and the second quarter. But I think what the consensus has lost a little sight of is inflation. Yes, January was a setback, I think, but you know, to me, the overall story is still the same, which is we have a period of disinflation in front of us. When I look at things like the employment cost index and the quits rate, the inflationary impulse from the labor markets are fading, and we also know that productivity is picking up. So unit labor costs have come under some control. And so to me, that kind of sets the table for the direction of inflation. So yeah, January was a bad month, but you know, talk to me in the spring. I wouldn't be surprised to see things like March, April core inflation come in weaker than expected.
You said at the end of last year, I remember the line, and you were right, the Federal Reserve started echoing that view. The labour market is no longer a reason for this Fed to be hawkish. That certainly seems to be the way they see things now. So what do you think is holding them back from reducing interest rates? What do you think they're concerned about?
Part of me thinks that they were surprised at how quickly inflation was falling in the back half of last year. I mean, if you told someone that 6-month annualized inflation in December of 2023 would be below 2%, if you told them that in the middle of last year, they would have been very surprised. But that's exactly what happened. So I almost feel like they didn't set the table to kind of communicate March. And I think, and frankly, I mean, even the last statement, it's basically a hodgepodge of language just to kind of, you know, I think get some of the hawks on board to kind of lay the groundwork for a cut. So, you know, my sense is that the May probabilities in the market are somewhat underpriced. You know, I think the markets, as I looked at them, you know, what's like 10-15% chance for a May cut. I think as the inflation data come in over the spring or March, April, I think those probabilities may rise.
So you can hold your bull stuffed animal, and I'm just going to hold the bear stuffed animal for a second.
Shocking.
I know it's going to shock you, but I'm listening to you talk about the disinflation and how it was a blip. But then how much of this is just entirely commodity driven, right? How much of this is actually not that people are paying, that people aren't shelling out more when they go to a restaurant and they make, you know, get omelets with some secret ingredient from IHOP? There is this feeling that there is some sort of sustainability in the services inflation. How do you not see that coming to the fore if we get, say, higher gasoline prices?
Well, it's interesting you mentioned higher gasoline prices, but obviously natural gas prices are down quite substantially, and we know that that's going to bleed into household utility bills too. So it's sort of a give and a take. We know that agricultural commodity prices are down. You know, I mean, you're probably going to mention chocolate, but you know, but when you look at the broad range of agricultural commodities, they're down, and that's going to bleed into what people pay at the grocery stores. But I think whenever you have things like this, it's important to kind of go back to first principles, right? And what do we know? Inflation expectations are down. The Conference Board data came out yesterday. 12-month inflation expectations are down. Longer run inflation expectations and short run inflation expectations for firms are down. That's from the Atlanta Fed's Business Inflation Survey. And ultimately, compensation growth equals inflation and productivity. So if compensation is running 3.5%, 4%, and productivity is running 2%, we're there. So, I mean, that's sort of how I'm thinking about it.
So I know that you also send out emails saying, like, everybody needs to wake up because this is a good economy and everyone needs to get on board. It looks like they're on board. What do you think they're doing in the equity market? I mean, how much more can you lean in after what we've seen?
In my experience, Lisa, momentum is an important driver of equity markets. So I wouldn't, I mean, you know, people talk about valuation and things like that, but there's, you know, I mean, there's no safety in low multiples. And, you know, I mean, valuation's a very poor timing tool. So if everyone's saying it's gone up a lot, that means it can't keep going up. I mean, usually in my experience, that means that it can keep going up.
Are you a May guy then? You're looking for that first cut in May?
I mean, I'm generally on the side that inflation is still slowing, and I think it's probably slowing more than the consensus thinks, so that leaves me in a position where I believe that they'll go a little bit sooner. Now, you know, things could be sloppy, there could be some residual seasonality in February, but again, it's about first principles.
Yeah.
Inflation expectations, if you survey households, they're going down. So, and as I mentioned, the labor markets are in much more balance. So I think those two things give me confidence that a lot of this, you know, setback that we've seen on inflation after several months where it's been coming in better is probably just that, just a temporary.
Do you think we see a little bit of this, sort of like they drop rates, but the long dot has to come up? Do we see a bit of that this year?
I think if the economy is growing the way I think it is, the likelihood is that all you can really expect is a recalibration of policy. And, you know, one way they could potentially signal that neutral is higher is by taking away some of the cuts that they have in place in 2025.
Let's talk about chocolate. So I was looking, actually, there's a Business Week story about chocolate and how chocolate makers are actually using less chocolate because it's gotten so expensive. And yes, part of this is droughts and things of that nature, but there's also a question of policy and certain ways that people want to...
Protectionist European policy.
Well, you want to say this, whatever, but
sure.
I want to bring up, you know, policy and how that's going to really factor into this inflationary outlook. If we do start getting tariffs, if we do start getting protectionism, if we do start saying, you know, for example, that Chinese auto manufacturers can't come here and that, you know, other people can't too for national security reasons, I mean, does that factor into inflation for you?
I mean, it does, but I mean, think about what would happen if they started announcing a lot of tariffs, right? I mean, would that be inflationary? Yes, but it would also be negative for growth. I mean, that would probably be, you'd see financial conditions probably tighten because the stock market would drop. I mean, we saw that play out in the previous administration. So, you know, tariffs are inflationary. What did the Fed end up doing? They offset some of Trump's trade war by cutting interest rates.
Well, what are your domestic and geopolitical concerns then? It feels like you have none.
I'm not a geopolitical person. I think that I just sort of take that as a given. It's something that everyone always talks about whenever the economy's going well. Oh, geopolitics could send oil prices up.
Well, there's 2 hot wars, though. And we have the Houthis regularly hitting vessels in the Red Sea. At some point, does that never come into your thesis of a concern?
It does, but I think at the same time, like, corporate profit margins are somewhat higher. So the fact that you know, supply chain disruptions have gone up potentially. I mean, it could lead to a situation where maybe firms are a little bit more willing to not pass those prices on because their margins are somewhat higher. This is not the same situation as it was, you know, a year and a half ago. So I do think in the aggregate, supply chains are in a much better place. You know, I mean, everyone kind of knows me, Anne-Marie. I mean, I do think that there are always risks, but I tend to kind of think that things have a way of working themselves out.
And they often do. Neil, it's good to see you, as always. Neil Dunter of Renmac, breaking that down for you. On Wall Street, in line is the new beat when it comes to inflation, or rather in line is the new downside surprise. Equity futures right now positive by 0.25% on the S&P 500. Just to give you a flavour of the bond market as well, yields are up at the front end by 4 or 5 basis points. Now positive just 2 at 466. If you look at foreign exchange, dollar a touch weaker against the euro off the back of the numbers, but on the session, that currency pair still negative on the day by close to 0.06%. Outperformance on a Russell, the small caps you would have seen there. there going into the opening bell. More on that in just a moment. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of Paramount are up in the pre-market. The company predicted, quote, significant earnings growth this year. It helped investors overlook a 6% sales drop. There is shrinking ad revenue on traditional TV channels that contributed to that. The company said subscriber growth beat estimates on its Paramount Plus streaming service, which it does expect to be profitable domestically next year. An Illinois judge has barred Donald Trump from appearing on the primary ballot. It's the third state to impose it for Trump's role in the January 6th insurrection. He has until Friday to appeal and is already appealing a similar ruling from Colorado before the U.S. Supreme Court. Another partial government shutdown is a step closer to being averted. Congressional leaders struck a last-minute deal to provide one more week of funding after the Saturday deadline. It keeps parts of the government funded through the end of September. But other agencies, including the Defense and Homeland Security departments, would still face a shutdown deadline of March 23rd. Speaker Mike Johnson plans to bring the one-week extension to the House floor today. That's your Bloomberg Brief. John.
Danny, thank you. They're coming after the chocolate. You see that?
That was just
Doesn't come up in that conversation. They're coming after the
serious.
chocolate. They just want you to be miserable.
No, well, you know, the fact that they're using less chocolate in the recipes at Mars and
There
other
you go.
things.
See?
What are you buying then?
They're coming after the chocolate. You're
Well,
on
I like
board.
your chocolate.
Up next, President Biden turning up the pressure on Chinese EVs.
When you look at the intense price competition that you're seeing in China right now, that's not sustainable for any company. And so we're positioning for where GM has to be to compete in a very different market.
We'll talk about that very different market up next. Live from New York, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
In line is the new beat on Wall Street, that's for sure. PCE, core deflator, coming in at 0.4%. The estimate, 0.4%. The previous month revised lower. Equities up a third of 1% on the S&P and the Nasdaq, higher by 0.6. Outperformance on the Russell, the small caps. Rate sensitive, up by 1.45%. Let's look at rates. 2-year, 10-year, 30-year in the bond market, treasuries. Yields were higher by 4 or 5 basis points at the front end, now up just a single basis point on a 2-year, 464.98. On a 10-year, unchanged at 426.78. Under surveillance this morning, President Biden turning up the pressure on Chinese EVs.
When you look at the intense price competition that you're seeing in China right now, that's not sustainable for any company. And so we're positioning for where GM has to be to compete in a very different market. You do need a level playing field. And I believe with our portfolio in many of the markets we compete around the globe, if there's truly a level playing field, we have a strong portfolio and we're going to do well.
Here's the latest this morning. The Biden administration calling for an investigation into Chinese EVs, warning of possible national security concerns. President Biden saying, quote, China is determined to dominate the future of the auto market, including by using unfair practices. China's policies could flood our market, posing risk to our national security. I'm not going to let that happen on my watch. Bloomberg's Craig Trudeau joins us now for more. Craig, here's the question then. So we've got tariffs already, 25% on Chinese EVs. You've got an extra 2.5% on imported foreign vehicles, so 27.5%. What next? Where are they going with this?
I think what we're learning is that, there's no losing in Washington right now in terms of, the race to be hawkish on China. I think it's the one thing that's sort of dividing everybody in Washington. And I do think that, the fact that the Chinese have come on so strong in just the last few years, where, BYD surpassed Tesla as the biggest EV maker globally last quarter. We've seen China overtake Japan as the world's biggest car exporter last year. I think the amount of fear, both here in Europe and in the U.S., about this threat that the Chinese pose to, whether it's the U.S. car industry, Germany, France, Italy, everyone's very concerned about this and sensitive to it. And so I don't think that this will necessarily be a sort of rare occurrence in the months and years to come.
Yeah, but Craig, define threat. Threat to the economy, to the national champions of this sector, or seriously a threat to national security? Which one is it?
I think maybe all of the above. I mean, even Elon Musk, who, is never one to shy away from, talking a big game, is, just in the last few weeks talking about this idea that, the Chinese are their most intense, and serious competition. And Elon Musk talking about the idea that unless trade barriers are put up, that the Chinese will, beat up on the rest of the industry. I think, he would like to think that Tesla is, very, very much primed to compete. And I think, of course, on a global stage, Tesla is still, very, high up there in terms of leadership. But, even Ford recently, too, talked about, the amount of market share that each of these companies have at risk as a result of the fact that the Chinese are just so much better on cost and so much, out in front of the rest of the world in terms of, lowering battery prices and being able to offer EVs that are actually price competitive relative to combustion engine cars.
We see China trying to make a massive inroad in Mexico. Is there a way they could circumvent what the United States has on the books now?
I think that may be a big part of why we're seeing this latest action that was formally announced this morning is basically trying to slam that back door shut. To the extent that that was potentially a path that a company like BYD was looking at as a way for them to get around tariffs on Chinese imports. Mexico, of course, has a free trade agreement where perhaps there may have been an opening there. If we see the U.S. look at Chinese vehicles on national security grounds, it would sort of be a way to get around the fact that a company like a BYD is looking at Mexico, is building a plant in Hungary as well, and just globally really sort of setting up all over the place to move beyond just being a major player in its home market.
China, we've seen in the past, have export controls when it comes to raw material processing technologies, which the GMs, the Stellantis, the Teslas will need if they want to make their own batteries. Do you think we could see a tit-for-tat response from China if the U.S. was to take this in a more aggressive direction?
I think that's absolutely something that the industry worries about. And we saw that, sort of come to pass just in the last few months when the European Union took a look at, started taking a look at China's subsidizing of its auto industry. You saw, some moves on, gallium and graphite and, various ways that, sort of on the margins, China seemed to be sort of sending a message of, it would be a shame if you were to crack down on us because, look at all of these ways that we control the supply chain. And if we were to turn the screws, it would make the transition all the more difficult for the U.S. and European car makers that have really struggled with gaining traction in this transition. Aside from Tesla, a lot of these companies outside of China have talked a big game, but really not been able to sort of get traction with scaling up their EV and battery business. Whether you want to talk about Volkswagen or General Motors or Ford, these companies set very high targets, big ambitions, but really have not hit the mark yet.
Craig, we're talking about electric vehicles and the U.S. auto manufacturers competing, but there was never the word electric vehicles or the phrase outgrowth of auto manufacturing. He was talking about protecting U.S. jobs. What is the ultimate goal here in terms of U.S. support for the big three in Detroit?
Yeah, I think that's a really good question, and I would go back to this idea of this tit for tat. And if we want to actually pan back a little bit and think about what China has done even just in the last couple of years, the fact that electric vehicles increasingly are connected devices with cameras in them. Just in the last couple of years, you saw actions taken in China to prevent Teslas from being around military bases in China. So the fact is this has been a concern that didn't just start this morning in Washington. It's something that governments have looked at closely, and I think it's absolutely perhaps a sort of novel way to look at the ways to protect your market for an industry that's so important, that provides so many jobs for people and good paying jobs. This is about industrial bases that economies have looked to protect for many years and will for years to come as we make this transition to EVs.
Hey, Craig, good to hear from you. Craig Trudeau of Bloomberg over in London. Bramo, we can see where this is going. This is going to become ultimately a state-sponsored industry. If you want to make that transition, and this administration is desperate to make that transition, they have to sponsor it themselves, provide a bunch of incentives, subsidies to do that. Do they want to do that and have a foreign manufacturer benefit from it? A foreign manufacturer with a massive cost advantage, and that's before we even get into national security issues as well. If you want these three to thrive in Detroit, you've got to put the walls up. Everyone's been saying that for a while. The walls are going up.
But we also have to figure out what the technology is that's essentially going to be the new car of the future, because that's still in the works in terms of tweaking around the edges. As you were talking, I'm thinking this is such a complicated thing to achieve, to put the walls up and to have a successful industry. I want to see an actual comprehensive plan to understand all the implications.
I'm looking through this statement again, and all I could think is this feels like it could be a blurb out of Lighthizer new book. China imposes restrictions on American autos. Why should connected vehicles from China be allowed to operate in the United States? Whether or not you get Trump or Biden, this is the direction of travel.
There's not much daylight, that's for sure. Coming up tomorrow, we'll catch up with Citi Steve Whiting, Avery Sheffield of Vantage Rock, Megan Robson of BNP Paribas, and Laura Rame of FS Investments. Live from New York City this morning. Equities doing nicely. No bad surprises coming from that inflation data. It's a rally going into the opening bell. The opening bell just around the corner. This was Bloomberg Surveillance.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, But it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. This euphoria in equities will not be interrupted. Inflation behaves and is even revised lower for December. The details to come on this show. We're counting down to the open. It kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Show the latest data providing some relief on Wall Street. U.S. inflation figures coming in pretty much as expected, reinforcing speculation that the rate cuts are on the way. We begin with the only issue in America, inflation.
Yes, January was a setback, I think, but to me the overall story is still the same, which is we have a period of disinflation in front of us. When I look at things like the employment cost index and the quits rate, the inflationary impulse from the labor markets are fading. But talk to me in the spring. I wouldn't be surprised to see things like March, April core inflation come in weaker than expected.
Let's get right into the results. Mike McKee is side by side with me. Mike, good to see you. So take me inside the revisions. And Neil Dudder really did have it spot on with the dividend comment.
Absolutely. He wins. I come in second. PCE headline up 0.3 for the month of January, which was bang on expectations, 2.4% at a year-over-year basis. PCE core 0.4, 2.8%. Now, both of those on a month-over-month basis are higher than they had been, highest for the core in a year. But given base effects, we see the year-over-year numbers continue to decline. And also what we saw was a revision lower. You can see 0.2 for December for the headline and the core. That has actually been revised down to 0.1 each month, which is why I think we're getting the reaction we are in the bond market. Overall, inflation is still going down, not as fast as people would want. Personal incomes were up on the month by 1%, which is a very big amount. Neil Dudda, as you mentioned, nailed it, 4.1% increase in dividend payments. Hold on to that thought. And wages and salaries up 0.4%, just slightly lower than they were the prior month. Personal spending, 0.2 gain. We had expected a slowdown, got that. And of course, we got to mention jobless claims, 215,000 up from 202,000, but still very, very low. All right, here's why we want to talk about the dividend payments. When you're looking at what is contributing the most, or a lot at least, to overall numbers in terms of the PCE. It is portfolio management, which was up about 5%. And overall, we're seeing that kind of impact on the markets because the markets have been so busy. There's so much turnover. There's a lot of charges, a lot of fees that go into that, and it's really helping boost inflation a little bit. The POGO problem. We've met the enemy, and he is us. Now, how long does this effect last? We know the Fed isn't going to do anything at their March meeting, which comes up late in the month. But next week, Jay Powell testifies up on Capitol Hill twice, and he will probably have a major effect on how bond markets position, and then equity markets, for what the Fed may do and for interest rates going forward. February jobs is next Friday, not tomorrow. And then on March 12th, we get the February CPI. Now, normally we talk about the PCE being more important to the Fed, but as they go into that meeting, this will give us more information about where inflation was in February, a little bit fresher data. So the Fed may look to that for some guidance in whatever kind of guidance they want to give us about when they're going to do any interest rate cuts.
Okay, Mike, thank you very much. It was a 1-2 punch on surveillance. Let's continue the conversation and the debate. My guests this morning are Gershon Distenfeld of AllianceBernstein and Julia Coronado of Macro Policy Perspectives. Julia, good morning. So a touch higher, a pip higher on some of these numbers on the PCE, but would you agree with Dutta, which is the disinflation narrative overall is safe?
Yes, I do agree with that conclusion. We're seeing a lot of January effects in the data, both on the income side and on the pricing side. But because they are more moderate sort of echo effect from what we've gotten last year, the actual year-on-year keeps declining. So I think, yes, I agree with Neil that, come Q2, we're going to see all of those beginning of the year effects fading, and we're going to see some lower prints, just like we saw last year, but even lower than the year before. So that year-on-year will continue to decline in our forecast. So looking at the details of this data, it still looks like we're moving in the right direction on inflation. And on the spending side, consumers are still resilient, came in a little firmer than we expected. Services keep carrying the day. Consumers pulled back on goods spending in January, but are still spending on services. So we still have a very solid economy with falling inflation providing consumers a dividend and resiliency in their spending.
And this is where maybe we need to review consensus and perhaps move away from the negative view. Gershon, good morning to you. You warned very clearly this would not be a paradigm shift, even if it came in a pip or two higher. It did come in a pip higher at plus 0.4% month on month. So in your view, are we still on track for the Fed to deliver 3 cuts? Because I think we were debating even that we would get 3 up until this point. There was so much prevarication.
Yeah, I think that we are on track to start getting cuts later this year. The real question is, and I'm glad you phrased that way, everyone wants to know, is it going to start in, May, June, later? It's not so much when it starts, it's how many we're going to get. And the markets come around to thinking the average is going to be more like 3 cuts. I remind everyone that when markets price in something, it's the average of all possibilities. And quite frankly, the Fed doesn't know what they're going to do. It really depends on how the data comes in, not just inflation, but on the growth side. So if things look very stable, we expect the Fed to start to normalize, which probably would result in 3 or 4 cuts this year and more in 2025. However, if, this has been a Goldilocks economy in many respects, if we do get weakness or unexpected downside, the Fed might have to cut a lot harder this year.
The question is, of course, where does that tail risk come from? And I'm going to ask you both the same question. I spoke to State Street a little bit earlier this morning. I said, there aren't many yellow flags in this data. The wages are strong. The unemployment rate is behaving itself. And I was pushed back by State Street, and they said to me, no, you're looking at the wrong data. Look at the lending in the commercial side. Look at the bank lending. Look at the commercial side of the business. Look at the consumer balance sheets, which are rising on credit cards. Those are yellow flags for State Street. Julia, are there yellow flags for you, or are you still firmly in the go green?
I think I would agree that a fading credit impulse, a tighter credit situation, more expensive money is a yellow flag. It should be something that is a headwind to growth as we move through the year. These are the lags in monetary policy. I'm a firm believer they're still there and working their way through the system. The other yellow flag we've seen is in earnings reports. Companies are very optimistic that they can maintain or even expand their margins this year on moderate revenue growth. But part of the reason they're optimistic is that their hiring intentions, which is something we track, we scrape these earnings reports and track hiring and firing intentions. We've seen hiring intentions continue to go down and a slight uptick in layoff intentions. And that hasn't shown up in jobless claims yet. And maybe that's either because it's not a widespread phenomenon. It could reflect that people that are laid off are quickly reabsorbed, or it could be that it hasn't just shown up yet in the data. So I would say that's something we're watching very carefully to see how companies, as the earnings season continues, what they're expecting to do on the job front side. Because at the core of every cycle is that positive feedback loop between spending and hiring. That is firmly intact right now. But, again, I think we are at tighter settings of policy, and that could lead companies to be more cautious on the hiring front.
So, Gershon, just 1 second before I come back to you on what to do with bonds. Julia, can I push you a little bit further in terms of the adjustments on the job front? Anecdotally, people are saying to us, this is higher end job losses in the higher echelons of management and mid-management, and therefore they're not able to sign on for their jobless benefits. Do you acknowledge that as perhaps a dislocator in the data at the moment?
Correct. Yes, absolutely. We are in a cycle where the job losses that we've seen have been concentrated in white-collar jobs, not blue-collar jobs. And those employees do tend to get severance packages. And so that keeps them on payrolls, essentially, as long as they're receiving severance. And so that would be the lag possibility, that it shows up a few months down the road.
Gershon, I look at treasuries and equities. I mean, we're in a suspended spate of euphoric animation as far as equities are concerned. And then I look at the treasury market. So you've got this mellifluous drift higher in equities, and you've got the bond market yields coming down ever so slightly. So suddenly we're back in a quasi-traditional relationship. We popped it into a chart for our viewers. Again, this brings me to the bond side of the equation. Inflation is behaving. Disinflation continues. There are no dramatic shocks in this market. But with a disinflation narrative and 3 cuts penciled by the market, is this still time to pick up maybe a hedge in treasuries as well as coupon?
Well, look, I do think that you point out the negative correlation is a good thing for markets. That's a normal thing. When the 10-year was at 1.5%, you weren't going to get that much. And for me, it's really a function of time, right? The longer that short-term rates are elevated, just the greater probability that something is going to break. Monetary policy works with a lag. And that's why, right, even if things are okay, the Fed is going to normalize because they know you don't have to have an event. Just stuff is going to break. Companies are going to have to refinance debt at higher rates over some period as well. So that's why the Fed is going to end up cutting regardless of what we see. But to your point, we definitely think that treasuries are going to be a good hedge if there's going to be a risk-off market. You mentioned equities. Equities, to me, have been incredibly resilient. You've really gone from a risk-free rate, long-term risk-free rate of 1 3/4 a couple of years ago to almost 5, now back to closer to 4.5. That should have, you think about it, should have had equities selling off, and they've rallied since. So I'm not an equity forecaster. I don't know what they're going to do going forward. Yeah. But certainly, you're going to want some protection in case they are overvalued, and duration is likely to do that for you.
But you would also say that whilst credit is expensive, you still see pockets of opportunity there.
Yeah, look, credit, everyone thinks that, we look at it's tighter than average. Well, it actually, spreads are tighter than average about 75% of the time. Or said another way, right, the median is a lot lower than the mean. A year ago, I was sitting here and pounding the table that credit was cheap. Credit's not cheap today. It may even be on the expensive side. But that doesn't mean that disaster is around the corner. All-in yields are impressive. Defaults are almost certainly going to come from the lower end quality like triple C's, which already trade at an average price of 78 cents on the dollar, many trading at 50 or 60. So even if those default, it's not going to have this huge impact on the market. The high yield market in particular, has never been higher quality, many more double Bs. So yes, are you going to get the kind of robust double-digit returns that you got last year? Very unlikely. But are you going to get better returns in credit than some of the quote-unquote safer fixed income asset classes? I think that's highly likely as well.
Julie, just to round off, we were beginning to see what was going on Macy's and Lowe's. We've seen a few other retailers come in. When you look at the personal income side of this balance sheet, it's robust, isn't it, surprisingly? Briefly?
Yeah, no, the income is surprisingly robust. Some of that is dividends, as you already mentioned. But what the retailers are seeing is that consumers have returned to price sensitivity. That's part of what's bringing inflation down. Consumers now want a deal. And that's a more challenging environment for the retailers.
Okay, team, stay with us. That's Gershon Distenfeld and Julia Coronado, my guest this morning on the Markets PCE Day. Let's look ahead. Before the opening bell, Abigail Doolittle has some of the movers. Abby, what's shaking?
Well, at this point, we do have the overall index futures, as you know, Manus, shaking higher in relief on that inline PCE number. But to the downside, Snowflake plunging down 21%. They put up a huge beat in the quarter, but it was the sales outlook miss and a change of CEOs. Well, it's weighing on shares. Wall Street overall not impressed. One analyst did upgrade. We'll be talking about that more at the open. Marathon Digital Holdings, despite a solid quarter, the stock's down about 4%. Perhaps the consolidation of the outsized rally, and then you, of course, have to wonder whether or not that's a tell of what could be to come for some of the other crypto stocks rallying in sympathy with Bitcoin back above $60,000 per Bitcoin. And then Tesla and other big tech names all spiking higher on that PCE print, going from about flat to right now up 1.2%. The idea that perhaps the Fed is going to be cutting, maybe not sooner, but at least as much as the market is pricing, and as you were talking about 3 times, and that liquidity will be a little bit more fruitful for stocks, Manus.
Okay, Abby, thank you so much. Abigail Doolittle, she will track the stocks and the sectors through the show. Coming up, well, new polling, trouble for the president at the moment.
This is a huge opportunity for President Trump, former President Trump. It's one of the reasons he won in 2016. And if Biden can't change the narrative here, he's going to be in even more trouble than he is today.
The latest on the 2024 election. That's next with Ami Hordan, our intrepid White House reporter.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Biden's on the defensive here, and this is a huge issue in the campaign this year. This is a huge opportunity for President Trump, former President Trump. It's one of the reasons he won in 2016. And if Biden can't change the narrative here, he's going to be in even more trouble than he is today.
Struggling at the polls, the border issue gains ground, and the economy is still, naturally, the top issue on the latest Bloomberg Morning Consult poll. The results show this. The border and President Biden's age are the two key sticking points with the voters, contributing to Donald Trump's lead over Biden in the 7 key swing states. Anne-Marie Horder joins me now. So, Anne-Marie, when it comes to the age and acuity test, Joe Biden in the swing states is not exactly knocking it out of the park. Good morning.
No, when it comes across multitudes of groups that we're going to see head to the polls in November, the continuous message is that Biden is just too old. And even before we're getting asked that question, this poll is asking respondents that question. People are writing it in, something they've heard or seen about each candidate. They will talk about Biden's age. So 8 in 10 battleground voters say he's too old. And this also, Manis, comes after that damning special prosecutor report that described the president as a well-meaning elderly man. We did hear from his physician yesterday, though, that pushed back and said he was fit for duty. When it comes to the former president, though, Donald Trump, if Biden is too old, Trump is seen as too dangerous. 6 in 10 voters nearly labeling him that. When it comes to remarks of things like NATO and the degradation of NATO, that's when we've seen some of these respondents pick up. Also, when it comes to the former president, Donald Trump, he would face a lot of issues and voters not willing to go out and vote for him if he was convicted. So that is why that issue yesterday with the Supreme Court coming out, Manis, and talking about that they're going to take up this immunity case for the Trump campaign, that delays a key court case that he is dealing with because he wants to extend that well past the November election.
It's interesting how the NATO aspect is now transferred very clearly into the polls, Anne-Marie, because we talk a lot about the domestic issues kicking in at the polls, but that global issue really coming home to play. Anne-Marie Horder on the very latest Bloomberg poll. Gershon Dissenfeld and Julia Coronado are my guests this morning. Gershon, good morning. To both of you, I was listening to Surveillance before I came on, and the conversation around the desk was neither of these candidates either have the desire nor the proclivity to go after the two big issues on the deficit, which is the medical care and indeed the entitlement program. To you, Gershon, for the bond market, is that what is not being talked about that I should be more concerned about, regardless of who gets in next year?
I think, Manis, you're exactly right. We live in a very polarized political environment, right? We think that Republicans and Democrats can't agree on anything. The reality is they won't say this publicly, but there really is no difference between the two parties when it comes to entitlement spending or getting the budget deficit, reining it in. Remember, Trump spent more than any other U.S. president beforehand. So, yeah, I think there's obviously lots of ramifications for who wins. I'm not a political prognosticator. I have no idea who's going to win. But, we don't really know what that means for markets. The bond market doesn't really care about budget deficits, doesn't seem to. Maybe that'll change one day. I don't think it's going to matter who comes in as it relates to that. I do think it's important to remember that even if we knew who was going to win, that doesn't necessarily tell us what markets are going to do. I remind everyone that the overwhelming consensus in 2016 was that Trump won, markets would crash. And of course, markets did incredibly well under him. So we really don't know. But to your point, it's exactly right. I don't know if markets are focused on it or not, but neither party is really serious about reining in deficits.
Well, I don't think markets tend to focus on this issue, do they, Julia, until the ratings agencies really, as it were, make a very, very clear noise, or bond markets revolt. So, Julia, when you look at the deficit situation in the United States of America, just give me your top line on the risk at the moment, because it is forever increasing.
Yeah, the deficits are wide, and that is sort of projected to be the case for the foreseeable future. They're not widening, so it's not a constant accelerating force. And it means somewhat higher interest rates. We've seen that. But it doesn't really reflect any concern about the dollar or the stability of the United States, at least not yet. The dollar is very strong. So I don't really think it's an issue, the main issue for markets. The market's done well under both of these guys, and with widening deficits. I think it's really more about the resiliency, stability, and strength of the U.S. economy. And that so far has continued to outperform. So I really don't think that the deficit is the main or will become the main issue in the election.
No, I mean, there is something, relative to the rest of the world, the US economy is on fire. It is turbocharged relative to the stagnation in the United Kingdom and the flatlining and even negative aspects of some of the German economy. Thank you so much for joining me this morning. That is Gershon Distenfeld and Julia Coronado on the markets. Coming up, your morning calls, and a little bit later, we'll dig into the markets on the equity side with Binky Chadha. He joins me shortly. But the market implications from today's inflation report, that conversation ahead on the flows at Deutsche Bank on Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
An inflation spike was the enemy of the equity market. The disinflation narrative remains very keenly in place. Two bids and offers. One is Snowflake, tanking by 20%. That is on the software side. And good morning, America. Good morning, NVIDIA. Don't worry, stock's up over 1%. We're all fine. We're all safe. There you go. I'll wait until that breaks. Let's have a look at some of the calls from the street. TD Cowen downgrades Macy's to market perform, expecting a restructuring of strategy to have limited impact this year. Citigroup adds United to its analyst focus list, highlighting the airline's positive earnings growth. And to close off, Jefferies downgrades Tapestry to hold, seeing limited upside due to mounting competition, down 1.3%. Next up, we're going to have a conversation with Deutsche Bank's Binky Chadha. He discusses the outlook for markets, the flow show from Deutsche Bank. Can anything stop the euphoria in equities? This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
So PCE, the headline, came in pretty much as the market had expected. Dig a little bit deeper into the core PCE, and that is a little bit hotter. But for now, these markets have euphoria. We're driving higher. NVIDIA is higher. Some of the tech stocks are on the, Snowflake's on the downside by 20%, but that's not enough to drag these markets lower. Yields are lower, and that is the ultimate base tone to this equity market. There's the opening bell, the euphoric at the NASDAQ. In terms of the price action across the rest of your asset classes, this is what we've got. Bitcoin, it's day 2 of the news flow. People like Skybridge are delivering pretty good returns on the back of this Bitcoin move. I mean, we had a wild ride yesterday, up 13%. We drive higher by another 4.5%. Liquidity is flowing to the ETFs, anywhere between $6 and $7 billion going into the newly minted ETFs, and open interest is up 90% since the late autumn. 10-year yields dip on the back of the well-behaved core PCE at plus 0.4%, and oil is up 1/3%. The speculation is about an extension in the cuts from OPEC+. Is that going to be enough to sustain the floor on the oil markets? Stocks is our game at 9:30 in the morning. Salesforce is on the ticket, delivering a lackluster forecast, but getting a boost after announcing its first ever dividend and an increase in the buyback. There's that word again. Abigail Doolittle is with me. Abby.
And this stock is all over the map, Manus, because just moments ago, or I should say minutes ago, the stock had been up more than 1%. In the after hours yesterday, after results were first announced, the stock was down. Right now, fluctuating more down, though, down 0.4%. So they did put up a pretty strong fourth quarter, very good execution there. But it was the outlook that weighs, or is weighing right now, with the stock down 1.2%, $38 billion for sales for this current fiscal year versus the estimate of $38.6 billion for this customer relationship software company. Now, instead of just focusing on the guidance to continued profitability, it's the operating margin of 32.5% is better than the expectation of 31.4%. So that could be something that could help the stock get back into positive territory, along with that increased buyback of $10 billion to a $30 billion total, and that quarterly dividend that you talked about, the first one, 40 cents per share to be paid in April. So it's clear that the cost-cutting measures are taking some effect for the bottom line. Lots of job cuts have been announced over the last several months, but sales growth is going to soon be the key as well. The company is attempting to address in a number of ways. This stock over the last year into today up more than 80%. So investors at this point, they're going to want to see more than trimming some of the excess numbers to make the bottom line look better. They're going to actually want to see more growth on top 2, Manus.
Abby, thank you very much. The magic words, dividends and buybacks in this earnings season. Let's stick with that because we've got Weight Watchers. The stock is plunging. This is after Oprah Winfrey said that she's preparing to leave the board. Natalia Kunijevic joins me now. The power of Oprah. Good morning, Natalia.
morning, Manas. Yes, Oprah joined the board in 2015, but this is not just related to Oprah's departure. The company posted disappointing guidance for the full year. They expect a big drop in revenue. They also lost about 200,000 subscribers last quarter, and there are lots of concerns for investors. But to take a step back, this is a company with a 50-year history. It was very popular in 1990s, 2000s, and historically, they also had lots of in-person meetings. So this is basically all about healthcare. They provide healthy diet plans. But now, as we can imagine, they are facing competition from similar companies as well as GLP-1 drugs. So three biggest concerns for investors. Number one, growth. Number two, liquidity. And number three is leverage. The company was able to get a very favorable refinancing during COVID-19 pandemic, but overall, now it has leverage at 10 times. In terms of cash, in total, they have 160 million cash plus revolver availability. But when it comes to debt, it's $1.4 billion. And bonds, Manas, are trading at a distressed level with yields approaching 20%.
Evolution in the market. Natalia, thank you very much on the Weight Watchers story. Let's turn to the media space. Paramount shares, they're moving higher after posting a fairly upbeat set of numbers for streaming. AMC, not as fortunate, coming in short on the profit estimates. It's a battleground out there, isn't it, Simone? Good morning.
It is, and the test for both of these companies was putting on a show that the future quarters in 2024 could be better than 2023 when both of these names experienced losses. AMC, after losses, massive losses last year, not able to convince investors that it is really turning the quarter. Despite Taylor Swift and Beyonce concert shows, which brought a revenue up 11% year on year in its fourth quarter, it saw EBITDA that fell short of estimates by 4.5 million. EBITDA was only 42.5 million in the quarter. That led to a cut in target pay for the CEO by 25% this year. Citi says no surprise that this name is trading lower today, substantially the most since November, especially considering January, February box office was down 45% from pre-pandemic levels. Paramount, however, able to tell a little bit better story here despite mixed results. Its streaming business subscriptions rising about 4.1 million from the previous quarter, now 67.5 million. And it says its streaming service domestically will be profitable next year, even despite the overall revenue miss. We're seeing some enthusiasm in the shares today, now up about 6%. But there is concern here. KeyBank saying that with at least one potential acquirer halting talks recently, we don't see much to get excited about. Maybe the only thing to get excited about is that shares closed at their lowest since November yesterday. So this news a little bit a positive headline for the company.
Simone, thank you very much. Let's turn our attention over to the hardware side of the business. HP shares, little change after Q1 earnings came in line with estimates. Ed Ludlow's with me. Ed.
Yeah, it's a pretty mixed bag for HP. It's a story about PC on the consumer side and a story about PC on the commercial side. After basically 2 years of sales decline, the street was looking for HP to tell us that they would at least rebound in the consumer unit. What we got was a decline of 1% on the consumer PC unit, $2.76 billion, and on the commercial PC revenue, 5% decline to $6.5 billion. What's interesting is the narrative looking forward. HP is saying we expect to return to growth in 2024 on the PC side of our business, and that will be driven by enterprise or commercial customers. A lot of that stems from improvements in software, which they can attribute and thank Microsoft for. Some limited upside they see in PC sales coming from AI. There's a big conversation happening right now, Manis, about us interacting with generative AI tools locally on device, both on PC and on smartphone, but we're yet to see that materialize in a kind of upgrade cycle that's coming. I find it really interesting. So HP just recorded the end of the fiscal quarter ending January 31st, but it includes the holidays. And if you look at the third-party IDC data, and it's reflected in HP sales as well, It's the weakest holiday period for consumer PC going back to 2016. So we're kind of waiting and we're a bit nervous, even though the stock's up 0.2% after a decline in after hours when they posted the numbers.
Ed, thank you very much. Ed Ludlow there with the very latest on the tech stories. Now, Deutsche Bank's Vinky Chadha says this, weighing in on the equity positioning. Solid inflows again this week. It's the 5th in a row. The inflows over these 5 weeks have totaled $75 billion. That is the strongest in 2 years. Inflows this week, again, being driven in part by U.S. funds. Binky joins me now. I mean, there is this sort of almost euphoric FOMO scenario. It reminds me very much of the meme frenzy from a few years ago. Binky, good morning to you. When you look at this kind of movement in the markets, are you comfortable with the pace and velocity? Good morning.
Good morning, Manus. In terms of the flows, they're clearly robust, but I would rush to point out that they're actually coming in line with the macro data. I think big picture, you want to keep in mind that we've been growing above trend in the U.S. for more than a year and a half now, and we look set to do that again, basically for the 7th quarter in a row in the 1st quarter of this year. So yes, we're getting robust inflows, but they're just as robust as the macro data, basically.
Okay.
And in fact, I would go wider than just the flows. Equity positioning or changes in equity positioning, which generally produce basically, very sharp moves when there are sharp moves in positioning, especially off of extremes. They're also in line basically with the macro data. So, if you want to find a boogeyman, it's the macro data has been good.
The macro data has been pretty stellar. I mean, again, this morning, PCE in line and real incomes there coming in, Binky. And this is what the Market Lives team are talking about on the blog. They're talking about rising real income support the S&P outlook. Fear ye not for the consumer. And that chimes with you. You've got 5,500 as your target. Strong real incomes is a pretty strong pillar in this narrative, isn't it?
It's a very strong pillar. I think it's also important to keep in mind that, a big part of it, if you're looking back over time, over the last year and a half, where did we get this strong growth? We got it because oil prices came off. And so real incomes, got a boost, and real incomes have basically been growing since. What happened in the summer of 2022 is something pretty unprecedented in the sense that we had real incomes falling for about a year. But the inflection point is really, post the Russia-Ukraine boost in oil prices as they started to come off. Real incomes basically began to grow again. And that, in our view, has really been the driver of the very strong growth that we've had. Now, inflation's come off, and so we are now talking about, much smaller sort of declines in inflation going forward. So that boost is going to taper off, but there's plenty of others that could boost growth. I mean, number one that comes to mind, of course, is destocking. Almost everybody and every company says that it's over, but it's not clear, universal or white.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus. male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Measure of equity positioning does not suggest euphoria. I think from a demand supply point of view, in terms of thinking about equities, you've got to think basically about the other drivers in the demand supply. And I would highlight really buybacks, which are, enormous driver from a demand supply point of view historically. And what is going on with buybacks is that in 2022, so all the way back in 2022, when earnings were falling, buybacks also fell. But in 2023, as earnings recovered, buybacks did not. So there's a lot of room for buybacks to rise. We can discuss, why buybacks didn't rise. But I think the key point here is that what we got from Q4 earnings is that buybacks are now picking up. So they have the room basically to rise. And they're a very important driver, basically, I would say.
Binky, fantastic context around the overuse of euphoria. If you look at it through the prism with which you have just presented, it gives me heart for deployment into one more rally in this market. Binky, thank you very much. That is Binky. Chadha, over at Deutsche Bank, be careful how abused you are with the word euphoria coming up in the show. Bitcoin reaches for that record high.
It's a bullish environment when it comes to Bitcoin. I think it speaks to just the overall risk-on environment that we're seeing from tech and others, where unless you have a telescope, it's hard to find this recession.
Conversation ahead on Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
It's a bullish environment when it comes to Bitcoin. I think it speaks to just the overall risk-on environment that we're seeing from tech and others, where unless you have a telescope, it's hard to find this recession.
Risk on everywhere. Thing of beauty. Bitcoin outperforming stocks so far this year. Investors are turning to alternative assets amid a wider caution in global markets. The token jumping 45% in the past 2 months, bringing the pandemic-era record high of $69,000 into view. You can smell it. Katie Greifeld is with me for more. What's driving this, Katie? Is it events within the space? Is it flow? Just give me the various components.
Well, this one is interesting because it comes amid not much action in the equity markets. Of course, we're hovering near those record highs on the S&P 500, et cetera, but you're not seeing the big, huge moves that typically accompany the risk-on appetite that you're seeing in Bitcoin. But I think it really comes down to supply, demand, and leverage. We know there's a lot of demand for Bitcoin right now. You can see that in the ETF flows. A lot of assets or a lot of fund flows competing for Bitcoin right now. Supply is an interesting one. We are approaching the halving, of course, that's expected in April. Basically, at that point, the block reward for miners will shrink. It will be cut in half. So people are thinking we're going to have some supply constraints on Bitcoin as well. And let's talk about leverage, because I think this is really an interesting and important part. You have aggregate open interest on Bitcoin derivatives, which can be levered up to 100 times, Manus. On centralized exchanges, that's risen nearly 90% since October. That's probably exacerbating some of the moves that you're seeing right now. To the upside, we'll see what happens on the downside when this rally, if this rally breaks.
Can I just say, as a former broker, that just the thoughts of that scale of leverage, it's salivating, quite literally.
I would imagine
you just write the tickets and it's 10 times bigger than you thought you were ever going to do. You talked about the dominance of some of the new players and the new entrants into this market. I mean, how dominant are the players? The flow is quite significant since the ETF was christened.
Yeah, the flows have been really impressive, I have to say, so far. You take a look at the BlackRock product, the Fidelity product. BlackRock's taken in $7.2 billion so far. It only launched in mid-January. Fidelity not too far behind. We're talking about $4.7 billion there. And then you have a solid middle class, as Eric Balchunas over at Bloomberg Intelligence would call it, also taking in more than $1 billion. So I think that demand for these spot Bitcoin ETFs have really surprised many across industries. On the other end, you do have the Grayscale product. That's lost about $7.8 billion so far. A lot of pent-up demand for selling, since in its prior structure, redemptions weren't allowed. But even with that, you're taking a look at net inflows for these spot Bitcoin products, and that's definitely contributing to the price, but also the euphoria around this asset class right now, Manus.
Okay, Katie, well, let's see what Mr. Novogratz is going to say later on in the day. There's a few of them coming out calling for a doubling in Bitcoin over the next 18 months. Himself and Skybridge Capital, I'm sure, are in the pack. Let's get the sector price action. Abby is with me.
Manus, we are looking at a 0.4% gain for the S&P 500, and it's a broad-based gain. Most sectors for the S&P 500, 10 to be specific, are higher, led by communication services. Some of those mega-cap tech stocks up 1.1%. We also have a nice pop for real estate with yields in just a little bit. Materials, tech, the one lone sector that is down, healthcare, down about 0.3%. So nothing too big there. Now on the month, because we are, of course, on the last day of the trading month, and most sectors are higher. Consumer discretionary, the best, up 8.2%. Industrial, so some breadth on the month, up nearly 7%. The one lone sector or subsector, take a look at that KBW Regional Banking Index on that New York Community Bank Corp below up on the increased reserves around commercial real estate loans. Well, it's down 2.5%, Manus.
Okay, Abby, thank you very much on those moves. Coming up, we'll set you up for the events for the rest of your trading day, right here on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill. This is Bloomberg.
To understand the deflator is to understand the core of what bond markets debate. This is the shift lower. It's not exactly dramatic, but this is when inflation PC is well behaved, goes in line, the market reacts solidly. This is about bond yields beginning to perhaps top out as we see that well-behaved PCE. And the market still believes that June is live for a rate cut. The transference is to the broader market as inflation is behaved. Disinflation remains the narrative, so the broader context of the Russell expands by 1.3%. That's the dependence on rate cuts for the Russell narrative. The rest of the markets remain firm. Nvidia also strong on the day. So at the moment, yields down, stocks higher. The correlation is very real. Stocks are rising. We'll hand you over to the rest of the team for your trading diary. In the meantime, Raphael Bostic speaks a little bit later this morning. We'll get more Fed speak. Goolsbee, Mester, and Williams reaffirming, I suppose, the long road to cutting. Dell reports the earnings after the bell. Friday, University of Michigan consumer sentiment, and we get the ISM manufacturing. That's it for a countdown to the open right here on Bloomberg from New York. I'm Manish Krenny. The rest of the team will carry you through the rest of your trading day. Good morning.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening to Bloomberg Intelligence. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast. Coming up, Mark Hoplamazian, President and CEO of Hyatt Hotels, is going to join us to talk about his company, the company's earnings, and the outlook. Plus, we're going to get a lowdown on what's happening in the media industry. We're going to get some consolidation there. We'll check in with Geetha Ranganathan. She covers the media space for Bloomberg Intelligence. And also, with Bloomberg Intelligence, Woo Jin Ho, Bloomberg Intelligence Senior Tech Analyst, break down some earnings from some of the tech companies. Hewlett-Packard reported some numbers. We'll get the latest there. But first, let's kick everything off with Mr. John Tucker, Bloomberg Business Rush.
Well, I like to say we're data dependent, so let's start off with data. Pending home sales. This is an eye popper. Much lower than we had expected, down 4.9%. This is on a month-over-month basis. The pending home sales down 6.8% on a year-over-year basis. So put that in your pipe and smoke it. Two-year yield down 1 basis point at 461. Investors were expecting something hotter this morning, but this morning's inflation number coming in right on expectations, and that pushing risk assets higher. The so-called core personal consumption expenditures price index, of course, that's the Fed's preferred inflation gauge, strips out food and energy components, increasing 0.4% from December. And reacting to this morning's inflation numbers, John Riding at Bream Capital says they should keep Fed Chair Jerome Powell on hold.
We have at this point a fairly solid economy and inflation that is slowly coming down. So why does he want to do anything at this point?
Right now, the S&P 500, 22 points higher. That is up 0.5%. We're at 5,093. The Dow Jones Industrial Average 46 points higher. That's up 0.1%. The Nasdaq 100 right now 143 points higher. That is up 0.8%. Just some of the earnings. Best Buy reporting sales beating expectations. The retailer making progress toward reversing the 2-year slump there. Shares of Best Buy right now, they are up just about 6%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Happy leap year, you guys.
Yes.
Oh,
by the
yeah,
way.
forgot about that.
This feels like something.
Right, so if you're a leap baby,
You
like,
pick and choose?
are you like 30 years old now instead of like 60? Like, would I be 30?
Yeah, how do you do that? You
Oh,
go
that's
the
nice.
28th or the 1st when your birthday is?
I don't know. Why are you guys looking at me?
I don't know, you like
I'm born
know
in April.
everything.
I got no idea. But there was a cool stat that Dan Curtis, who kind of runs all our market coverage over in London, said that I think that in every leap year, stocks wind up going up. Now, obviously, like correlation, not causation, etc. But that was a fun stat. You know what I mean?
That's a
like you gotta
Bloomberg
like
stat.
that. That is a Bloomberg stat.
How often is there a leap year?
I don't know. Why are you at?
every 4
is it
years?
4? These are the things you
I'm
should
just
know,
throwing it
John.
out there.
Yeah, this is the
This is a you question.
Yeah, I know. I came unprepared today.
You did, yeah. There's more homework to be done. So stocks are up to that
Yeah.
point. There's that. There's earnings. There's I think the nothing burger for the PCE.
On the
but that's
inflation,
just me. Yeah.
Yeah, I mean, Bloomberg News, I was reading the Bloomberg News reporting, you know, they're saying it's higher than it's been recently, but it's right in line with expectations. I guess you could, we had John Riding on earlier, and he was saying basically, it just says to the Fed, you don't need to rush into anything.
Right. Like it could have been worse.
Yes. Oh, yes.
Like either
Yeah.
way, to the up or the downside. No, that's fair enough.
Yeah. So anyway, the S&P is up 0.5%. In part on that news, we saw the tape kind of start moving higher when we got that PCE data. Let's check in with Nora Melinda. She covers all of these equity markets for Bloomberg News, and she's here in our Bloomberg Interactive Broker Studio. Nora, what are you looking at today in the stock market?
So we've got major indexes here in the green, but there's a couple stocks I'm looking at here in the red. Let's take a look at Snowflake. That's ticker SNOW, and those shares are tumbling as much as 21%. Now, this company did report fourth quarter results that were better than expected, but it's on pace for its biggest decline on record, its biggest one-day drop in history, after its sales forecast and first quarter profit revenue disappointed analysts. And of course, the company also did report that its CEO, Frank Slootman, is stepping down, and its senior VP of AI will now be assuming that role. I mean, I think there's been some speculation as to why, but I think
It was really sudden, which I feel like that is the difficulty.
That's what's hard to chew on.
Yeah. And also, I think their outlook, right, wasn't as great as
Exactly.
we thought, even though the numbers were more solid.
Especially.
What do we learn from Hewlett Packard? So this one is HPQ, right?
Yes.
So this is a straight up, here's my PC, here's my printer.
Exactly.
Okay.
Important to make that distinction here. So good point. But HPQ is focused more so on the PC side of things. And these shares are recouping some of their losses, but they were earlier falling as much as 3.7%. Now that's the most intraday since September. And the company's really been seeing 2 years of sales declines, and the street was really looking for some improvement as it pertains to the consumer side of things. And it did see a 1% decline in that space and a 5% decline on the commercial side. So really just a slump when it comes to personal computer sales, and its revenue did slightly miss expectations. The CEO is saying that PC sales should increase this year, but of course investors are just waiting to see some delivery on that.
What else you got for us?
Let's look
What else you got for us? Sorry about that.
No, let's look at WW International. So most people know this as Weight Watchers, but the really
WWE
interesting...
International makes me think of WWE.
Doesn't it?
Yes.
Yeah.
Doesn't
so
it?
It gets confusing when you feel like Oprah's going to get off the board, not going to seek re-election. You're like, wait, what?
WWE?
Oprah's not wrestling anymore?
Yeah, it's so weird.
Oh, no.
Anyway,
But this one's Weight Watchers, and of course we all know Oprah and her famous commercials when it comes to Weight Watchers. But the news here is that those shares are slumping as much as 27%. Now this is the lowest intraday level on record, and Oprah said that she's leaving the board, and she's been with them for about nearly a decade, and she's not going to be seeking re-election in this space. But it's really interesting, especially as we think about some three key factors here. A lot of investors are looking at the company's growth, liquidity, and leverage. But as we think about Ozempic and the trials that come from that, it's really hard for Weight Watchers to really stand out here.
Lisa Mateo from Bloomberg News reported in one of her segments earlier that I guess Oprah disclosed or said that she uses some of these GLP, uses one of them for maintenance. I guess it was
Interesting.
term.
Interesting.
So, full disclosure there as it relates to, I guess, the relationship with the Weight Watchers.
That's
Because that's been, that's a concern for that company and that industry. If I could just do a shot or take a pill.
Ozempic.
Yeah.
Yeah. The specific
Yes,
one that
okay,
she uses,
okay.
yes.
Yep, so that's been an issue there. So,
That's
interesting move. Okay, anything else there, Nora?
Got one here in the green. Looking at Duolingo, I want to know: do you guys speak other languages, or?
Oh no.
I need to sign up for this
I mean, I guess I could speak Latin if I had to.
Me too.
I won a Latin award
that
in high
comes in
school.
handy.
It does. doesn't
Wait,
it?
how long were you
I know
doing
what nota
Latin?
bene is. I mean, that's something, right? I don't know. This was a long time ago. Anyway.
Can you conjugate some verbs?
Right, please.
I could.
For the class.
Maybe. I don't know. Maybe I'm overselling myself. Okay, but apparently if I did want to learn a different language, this would be where I would go.
Of course. And now Duolingo is actually stepping into some other classes like mathematics and music. And they're really leaning into that AI side of things. And so they're expecting that this should actually attract more customers and lower costs. So that's really what investors are looking at here.
All right, Nora, thank you so much. We appreciate it. Nora Melinda covers all the markets for Bloomberg News, talking to us about what's happening underneath the hood. The S&P 500 up 0.4%. So again, we had some inflation data today that pretty reasonable, I think, kind of in line with expectations, maybe helping the market move along here. All right, let's talk a little C-suite conversation here. We can do that with the hotel business. Mark Hoplamazian joins us. He's the president and chief executive officer of Hyatt Hotels, joining us via Zoom. Hey, Mark, thanks so much for joining us here. I'm looking at your stock here, 52-week high. For those that don't know, H is the symbol. It's cool to get that one of those single letter symbols there. That's always pretty cool for us Wall Street folks. It's got a market cap of $15.7 billion. Stock's up about 0.3% today. Mark, talk to us about your recent earnings and kind of what was the messaging you needed to get across to your shareholders?
First of all, it's great to be back with you all, and thanks for having me. I think the clear message was really centered around the fact that the transformation of the company to an asset lighter platform has now shown up in the numbers in a very material way. We had the highest free cash flow in the company's history. We also had the mix of our asset light earnings to our total earnings went up to 76%. 5 years ago, that was in the mid 40s.
Hey, Mark, could you describe first what your asset light strategy is? Is that relying more on franchisees?
Yeah, so it's not really, I wouldn't call it an asset light strategy. I would call it an asset light program where we were selling down. We had two major drivers of our earnings. One was from real estate that we own, hotels.
Yep.
And the other was from management and franchising hotels across the world. We're primarily a management business, not a franchise business, but those are the two businesses. So as we sell down real estate, the proportion that's coming from real estate sourced earnings has been dropping. We've concurrently reinvested in buying new platforms and new brands over the last 5 years, and that has driven up our management and franchising fees at the same time. So the mix has shifted to much more in the management and franchise fee driven business, which is very low capital intensity. And high margin and high free cash flow conversion. So that was probably the key message. The other thing that we did is we simplified our financial presentation because we have a business that's a subscription model membership business called Unlimited Vacation Club. And we sold the majority interest in that business to a third party, which helped us simplify how we report our earnings. And that was very well received by investors.
So, Mark, that's you in the C-suite managing all of that. What about the demand side of the business? What kind of pricing power do you have per room, and what's the demand situation like?
Actually, demand, so we think about three different demand drivers. One is leisure, which has been the leader of the recovery through post-COVID period. We think about group business, which is big meetings and conventions and things like that. And we also have business travel, individual business travel. All three are showing signs of great momentum and positive outlook. So starting with leisure, in the first quarter of this year, our pace, meaning our bookings, are up 11% for our all-inclusive resorts in the Caribbean and also up for our resorts in the Americas. but leisure travel has been really, really solid. In China, we had a record year for Lunar New Year. The spending amongst Chinese, both inside of China and to other destinations in Asia, was at an all-time high. So that's leisure. In group, our pace into this year, that is forward bookings, are up 8%.
Connection lost.
And so we're looking at another solid year of growth in meetings. And I think corporations are increasingly resolved to make sure that they prioritize those meetings. And then on business transient, the U.S. is lagging, but the overall business transient category demand around the world is about 7% below where it was pre-pandemic. So we're getting closer and closer to being at parity. Europe is fully recovered and then some. China is fully recovered and then some. The United States is still lagging. So, and we're seeing signs of positive signs of business transient travel increasing. So I would say across all three major categories, we're seeing positive trends into 24.
Mark, could you talk to us about M&A and kind of growth via acquisition? How does that figure into your growth plans? What are you guys messaging to the street about your willingness to engage in M&A? Because I know you had a buyout recently of the Apple Leisure Group. I want to see kind of what your appetite is going forward.
Yeah, so over the past 5 years, we've invested about $3.8 billion in acquisitions. The biggest one being Apple Leisure Group at $2.7 billion. And it's been tremendously beneficial to us because we've been able to expand our customer base in the highest growth and most relevant to us categories, which is leisure, lifestyle, and luxury. And so we've really done this in a very deliberate way to move the company in that direction. In the fourth quarter, I think we had 57% of our total rooms revenue around the world was leisure focused, which is up 20 points from the mid-30s to the mid-50s pre-pandemic till now. So the mix in the company has tremendously shifted. But they've also been very profitable and high-value acquisitions. The fees per room that we are earning today are materially higher than they were 5 years ago before we made these acquisitions and evolved the company, even as we have grown our select service brands. So we are expanding in lower price points, but our overall fee growth per room has been growing, which is really, I think, part of the equation of actually driving shareholder value on an accelerated basis. In terms of our outlook, I think there will be more opportunities for M&A in the future, but probably smaller scale.
Mark, Paul and I talked about the story yesterday. For the Journal reported that hotel parking fees are spiking because of the fact that you guys that own hotels have to pay more in rent. Interest rates have increased. Maybe there's a demand issue in certain pockets. You got to increase prices where you can. Talk to me about how expensive it is to run your business. Like, where are costs coming down? Where are costs going up?
Yeah, I think the primary, look, first of all, let's start with the biggest cost category, which is people at our hotels. And in 2021, non-union markets, which is primarily in the South, the Sun Belt, the smile of the United States, I think our wage rates went up by 20% over the course of that year. And that started to mitigate or ameliorate in 2022 and 2023. But we experienced a massively acute situation in terms of supply of labor. That's evened out. We were in the mid-teens level.
So that's evened out in that, because we also talked about, didn't we, Paul, about cleaning services, like not staffing, housekeeping, because you just can't find the workers. So do you feel like you're at the right spot?
I would say that there are pockets where we still have shortages, and I think part of that has to do with the nature of the workforce at this point. So we've got a lot of the byproduct of not having a really advanced immigration policy in the United States and H-2B visa program is that at times, especially over the summer where you have peak demand, we don't have the right type of labor that's willing to take those jobs and be happy to start their careers in those jobs. So I think they go together. A lot of the H-2B people that come in on an H-2B visa, which is a temporary work visa, they come and they leave. or the incidence of immigration that allows us to hire people who are coming into the workforce in the United States for the first time has been under some pressure. Now, having said that, overall, our vacancy rates have gone from mid-teens to mid-single digits, so down 10 points, which is extraordinary, and that's over the last 18 months. So we are having a better time finding labor, but there are definitely pockets of constraints still.
Yep, we hear that from a lot of folks in the service business. Hey, Mark, thanks so much for joining us. Mark Hoplamazian, he's the president and chief executive officer at Hyatt Hotels, joining us from Chicago, Illinois via Zoom. The company stock, H is the ticker, all-time high today. So how about that? They had some pretty solid numbers, recovering from the pandemic, like we see a lot of other entertainment and leisure spaces. We'll have more coming up. This is Good.